now that we've priced in these greater odds of the recession, I would say the market is probably going to be more sensitive to any sort of positive surprises.
That might be part of the problem, in that we are being whipped around on every single cyclical data release.
Financial markets aren't as important as they think they are.
In my outlook for equities, it does not figure prominently what the Fed does one way or the other.
They ought to be, and I think they will, erring on the side of caution if we do get additional negative data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Did I miss anything? What did I miss? Welcome back. This is Bloomberg Surveillance. I hear it's August. Supposed to be sleepy. John and I are playing vacation tag this week. He's it. I'm thrilled to say Danny Berger will be joining myself and Anne-Marie for the rest of the week. So evidently I missed a doozy of a week last week. Trifecta of exploded carry trades, crowded positions, new growth fears. Question now, heading into this week, Danny, is roller coaster over?
I fear not, just considering all the data we have. PPI, CPI, retail sales. It almost feels like it's going to be a mini referendum on the little micro chaos of last week. Because, yeah, markets are basically right where they started. It's almost as if you didn't miss anything, Lisa. Well, but, you know, the volatility in itself is important.
But I missed some auctions that were actually important for once. So we'll get to that in just a second. There's still a question of what actually happened last week. And Anne-Marie, some people are wondering, is this just the idea of leverage getting pushed out of the system? Is this something really fundamental about the weakening of the consumer?
One thing we continued to hear last week, Lisa, was that this was really a perfect storm of a number of issues at play. This week, of course, the consumer will be front and center. We get those retail sales, but also we get the likes of Walmart. Remember, when they reported earnings in the last round, they said they saw broadly consumers starting to trade down. So that bifurcation of the consumer, maybe some of those on the upper end are starting to also look for deals.
There's also a question of how much this is political. There's been a reversal of the Trump trade almost entirely, and this question about whether the Harris wave has really begun and what that looks like. How much credence do people who you speak to give to that?
Well, Lori Calvasina put this in her note when all of this was really blowing up and the markets were experiencing all this volatility, and people are trying to decipher what exactly is driving this. And she said one dynamic could be the elections. They're shifting in a way that is challenging to the stock market. The S&P 500 has positively correlated with Trump's betting market odds, which have been deteriorating and now lag Harris. But Terry Haines will be joining us, says, beware the Harris trade.
All I can say is there's so many different swirling winds. A lot of it, Danny, ultimately comes down to leverage in the system, which Goldman Sachs says had surged to some of the highest levels going back 10 years in data that they compile. Questions around the Japanese yen carry trade, how much that is over and unwound. Do we have a sense of how much some of the discrepancies in the market sort of positioning has really right-sized?
Well, every estimate is different. And I think this speaks to the point of it's kind of unclear. JP Morgan says 75% unwound to the carry trade. Morgan Stanley says 60%. Bank of America says the bulk of it is over. But the concern is you had this big move on Monday and the Japanese stocks rallied. I mean, they didn't even end down double digits for the week. So how much of that just encouraged people to reload back up? Yeah, sure, you sold off on Monday, but what if you saw that as, hey, it's good news. Stocks could end the week unchanged. Maybe we got complacent again.
Have we really killed off the optimism? Well, coming up this hour, we've got a great slate for you to really dissect all of what we've seen right now in markets. You could see basically trying to reclaim some of the losses that really didn't stick last week. This week, we're seeing just basically range bound, 53.72 on S&P futures. Euro, this might be one of the most interesting areas to watch. How much the euro gains versus the dollar, not because of euro strength, but dollar weakness because of some of the Fed rate cut bets. 109.28, 10-year yield still sub 4%, 394.74 in crude after a monster week last week of 4.5%, gaining yet again up more than 1%, $77.75 traded on the NYMEX. Here's what we've got coming up this week. It's going to be a really big one in terms of the consumer and in terms of inflation. We get PPI coming out on Tuesday. On Wednesday, we get CPI data. Does the Fed see inflation coming down, decelerating enough to justify the September rate cut and even potentially what's baked into the market, which is a 50 basis point rate cut at some point this year? Home Depot reports on Tuesday. Thursday, we get retail sales and jobless claims as well as Walmart earnings. All of this pointing to the key question, is the U.S. consumer getting too tired to uphold the rally that we've seen? Coming up, Michael Shaoul of Ion Macro Management with stocks coming off 4 weeks of losses. Terry Haines of Pangea Policy has come Kamala Harris pushes ahead of Donald Trump in 3 swing states, and Nela Richardson of ADP ahead of a key week of economic data. We begin with our top story, stocks edging higher ahead of a key week of economic data. Michael Shaoul of Ion Macro Management writing this: the market's reaction function seems to have flipped, with bad economic news driving risk assets lower, which typically occurs at the transition point for the economic cycle. Michael joins us now, I'm so pleased to say, in his very first interview in his new fund at the New Post. Michael, great to see you. Congratulations. I want to just start there. Are we really seeing a tipping point in the economy that justifies the volatility of last week?
I think, as I said, it's a change in the reaction function. It's not that the economic news has changed so drastically, but I mean, this all started with the CPI print. It didn't start last week. It culminated last week. It started on, I think, July 16th with that CPI print, with the dollar's sudden weakening. That was the yen sudden strengthening, helped by the Bank of Japan jumping in. And since that point in time, whenever we've had weak economic data, risk assets have gone down, the equity market's gone down, and when we've had decent economic data, it's gone up. We had a tiny beat on the jobless, on the initial claims number on Thursday. We had a stronger than expected ISM services index. The market was still down that day, but it rallied at the point that number came out. And this is something different. Since we started worrying about inflation in 2021, strong economic data typically sent the market down, sent yields up. So it's not necessarily that the economy is at a different point, but I think the balance of investors' concerns have changed. Investors are more concerned about a recession and a weakening economy than they are about the risk of upside inflation.
If we're talking about the reaction function of markets, last week bonds actually acted as a hedge, and you saw them become the haven trade that they have been traditionally. Mm-hmm. Do you see that sticking in periods that, according to what you're explaining, seem like they're prone for a lot more volatility?
I think right now, yes. I think for the remainder of this summer, I think that bonds will, as I say, if you get weak economic data, bonds will go down. Sorry, bond yields will go down, bond prices will go up, equities will go down, and the reverse is true if we get stronger than expected economic data. And so that's a little bit different. Now, that again poses problems for people who have set up portfolios anticipating a different kind of correlation. So one of the things I think which has fed into the chaos of the last few weeks is that portfolios are not reacting in the way people would have expected to a certain input.
That's a really interesting point. I want to dig into that more. So are you basically saying that a lot of this universe right now is set up that bonds and stocks don't have their normal negative correlation,
Correct.
That people currently are not prepared for this new environment that we're about to go into?
Well, or I think some of the chaos we've seen in the last few weeks that people suddenly, people are smart. If I've noticed it, someone else has noticed it. and you're probably starting to see people sit down and look at their portfolios and say, look, we no longer anticipate it to be, if I know that CPI this week is going to be 0.1 versus 0.3, this is now what I expect my portfolio to be doing.
Okay, so on that note, and correct me if I'm wrong, part of the switch is that inflation isn't a concern. Because when inflation was a concern, that's when you saw the bond stock correlation got out of whack.
Yep.
But what does it mean to have Fed officials, Michelle Bowman, Susan Collins, to still be saying we are not confident inflation is low enough that we can cut? What does the push and pull between markets and Fed officials look like then? I think Fed officials and markets are often in a point of conflict. I personally don't think the economy is falling apart, but I respect the fact that the market's more worried about that than it used to be. As I said, to the extent you see Fed officials push against rate cuts over the short term, the market's going to be nervous.
But is the Fed almost creating this environment because they've become so data dependent?
Yes, and guidance dependent as well. I mean, the Fed did not used to guide in the way that it currently does. Look, I think setting Fed policy is always difficult, and it always goes through different fashions. If you went back 18 years ago, the Bernanke Fed started under Greenspan. It was 25 basis points every meeting, and we used to joke, you don't need a calendar, you just need to tell me what interest rate it is. So we have this current paradigm with the dot plots and with sort of excessive guidance and data dependence. You're probably nearing the sell-by date. We're probably heading towards a much more opaque Fed. And if you end up with a Trump presidency and you listen to what he's saying, a Fed with a lot more political, even if it's only verbal interference, a lot more political interference.
When you say Trump potentially might come back into the Oval Office, we've seen now the race is very tight, and people are questioning if some of the unwinding was the Trump trade unwinding. Do you believe any of that? Is that part of it?
I do. I do believe that again, you had, it wasn't the biggest driver in portfolios, but at the margins, you did have people. It did look in that period after the debate as if you had a fairly straightforward election, as much as they're ever straightforward, and there were certain things which were favored, and certainly, it's no longer as certain as it was, or if anything, the certainty is moving in the other direction. So yes, at the margins, that will have been a factor.
So you're starting a new fund right now.
Yes.
What are you doing? How are you positioning it?
Not entirely sure. Still have a couple of weeks. To make up my mind. Look, I'll say this. I think this is this is a harder environment than markets were, say, 3 months ago. I think the global economy is still okay. I still think I think the Chinese are edging towards doing something. They're having their own battle with their bond yields being too low, ironically, and you're starting to see a little bit of impatience there. So I'm reasonably positive about the global economy. But as far as markets are concerned, I look back to summers like 97 and 98 that started off with similar chaos in FX. In those 2 years, it was EM rather than DM FX. And you got this sort of secondary wave of volatility in sort of September, October. I wonder whether that's something we have to look forward to. Again, both of them ended up okay by December, but you had some rocky periods to get through. So, September, October might get interesting.
Is this a financial problem or an economic problem?
I think it's a markets problem more than anything. I think you had tremendous imbalances in, everybody wanted to do a very limited number of trades 2-3 months ago. And look, this all turned around in the middle of July. We've often highlighted to people the middle of July is a very important period because what happens is people start the year with a certain set of assumptions. Sometimes in the first half of the year, they realize they should have been doing something slightly different. So the first half of this year, people were quite invested. By July, everybody was fully invested. US tech was number one. Short VN was number two. There were 2 or 3 other things in there. And I think what we had more than anything was a massive overcommitment of capital to a limited number of themes. And that unwinding is a messy process. We have to get back to more normal portfolios. And I don't think we're there yet. I don't know if it's 65 or 75. But you don't normally go from 100% commitment down to 0. You normally end up at minus 50. In other words, the pendulum overswings.
Well, good luck. And Michael Shaoul, don't be a stranger. Congratulations again of Ion Macro Management. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hakez. Yahira.
Hi, Lisa. Foreign investors pulled a record amount of money from China last quarter. Outflows reached $15 billion during that time, marking just the second time the country has recorded negative numbers. That's according to data from China's State Administration of Foreign Exchange. Should the decline continue for the rest of the year, it would be the first annual net outflow since at least 1990, when comparable data began. A Bloomberg survey of economists now showing the ECB is likely to cut rates once a quarter through the end of next year, a timetable that would see the central bank's easing cycle end sooner than previously thought. The economists expect the benchmark rate in Europe to reach 2.25% by the end of 2025. It had previously been expected to hit that mark in 2026. Growth in Europe's private sector slowed in July, while economists also lowered their forecast for growth in Germany. And Paris handed over the Olympic baton to Los Angeles in true Hollywood style, having actor Tom Cruise rappel from the roof of the Stade de France into the closing ceremony. LA will host the next edition of the Summer Games in 2028, and already planning is well underway, with the city's mayor addressing the big issue, saying they'll encourage remote work and non-standard working hours to prevent traffic chaos during what she calls a no-car Olympics. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I got to say, this was a very exciting Olympics. It felt like it was sort of more unifying.
You got to witness some of it.
Well, I went to Paris for a day. I didn't actually see any Olympic Games, but the enthusiasm there was really inspirational.
Well, you saw the torch, and I feel like that's everything, right? It's like in the center, it's this glowing orb. What else do you need to see?
That's what I told
the
my
men's
son.
basketball game looked amazing.
Yeah, we'll talk about that more next. But more of this up next. The Harris trade rolls on.
We like hard work. Hard work is good work. And with your help this November, we will win.
That's coming up next. This is Bloomberg. Mohammed, we saw you there. We saw you in the stands watching the men's basketball game in the Olympics. You are at every single cultural icon event, and we want your life. Welcome back. This is Bloomberg Surveillance. On a day where we're trying to claw back some of the losses that mostly were clawed back from last week. We're up now about 0.1%, 53.76. You wonder how many real people are in their seats or how many people take a page from the Jonathan Ferros of the world and are off on vacation. Euro climbing versus the dollar at 109. We're watching that pair very closely. Under surveillance this morning, the Harris train rolling on.
We know this will be a tight race until the very end. And so let's not pay too much attention to the polls because we have some hard work ahead of us. But we like hard work. Hard work is good work. And with your help this November, we will win.
Here's the latest. The Harris campaign riding a surge in donations, raising over $12 million in an event in San Francisco. Harris winning in the polls also. The latest from the New York Times showing that Vice President is leading right now Donald Trump in the key swing states of Michigan, Wisconsin, and Pennsylvania. Terry Haines of Pangea Policy writing this: from now until the first debate, the race momentum very likely continues pro-Harris. Post-Labor Day, Harris is likely to be the clear front runner, but there are many potential Harris speed bumps. Terry joins us now. And Terry, I'm going to ask you the question that Anne-Marie and I were talking about earlier this morning, which is how much of what we've seen in markets is the unwind of the Trump trade and the Harris wave that we've seen in polls?
Oh, I think quite a lot of it, Lisa. There's a situation where everybody gets way over their skis for one event and anticipates it, and then when that starts to unwind, they jump on the other horse. And markets do this all the time. You don't need me to tell you that this morning. But the proof in the pudding is going to be whether or not those trades are those trades in that bandwagon is valid. And what markets forget in the presidential election years, but remember every other year, is that Congress has as much or more to do with this than who the president is. Right now, the base case is that the Congress is going to be politically split. So whatever happens with either of those trades is going to end up being less dramatic than markets anticipate, I think.
Terry, how do we know what a Harris trade is when we really don't know what her policies are?
That's a very good question. I think the answer to that is not speaking for markets, but I think the answer to that is people consider and continue a status quo. That, by and large, the Biden policies will become the Harris policies. Number one, and number two, what you do get is a Democratic platform that's already been approved by folks and will be rolled out at the convention. That's already out there, so you have some idea of what there is. What I hope markets see beyond all this is an increase in defense spending and building up the defense industrial base, regardless of who the president is, frankly, because that's the most bipartisan policy there is.
You mentioned Congress, so I want to give you a little bit of what President Biden had to say over the weekend. He said one of the reasons why he dropped out was a number of his Democratic colleagues in the House and Senate thought that he was going to hurt them in the races. Have you seen materially in the polls, since Biden has stepped aside, down ballot, that potentially there is more seats that Democrats can pick up, whether it comes to the House or the Senate?
Well, I think so a little bit. Yeah, I'd take issue with the president. even before he dropped out, the vast majority of people were running ahead of him, particularly in the Senate. Senators, incumbent Democratic senators that are up for re-election were already doing better than Biden was. So there was a lot of talk that those senators actually might pull Biden up rather than the effect that Biden talks about. But yeah, I think what happens is that the Democratic idea of taking the House back by targeting a relative few seats in blue states probably is more likely to happen than less likely to happen, simply because the enthusiasm for Harris and the enthusiasm for the ticket is way up compared to where Biden was.
One piece of policy we have been able to get out of both campaigns is how they view the Federal Reserve. And over the weekend, J.D. Vance doubled down on what the former president said in terms of potentially the president should have more say on directing monetary policy. Do you think this can hurt the Republican ticket?
Yeah, I think it does on balance. You know, what Trump and Vance are trying to appeal to is this kind of end the Fed crowd. And, you know, you're at this point in a campaign, you're throwing out little bits of meat for everybody and on the hope that they bite and stick with you. But, you know, I think on balance, it's silliness or worse. The idea that, you know, it's a very short step from talking about how to corral the Fed, which is constitutionally impossible for the executive branch, by the way. I mean, these are powers derived from Congress. It's not anybody's opinion. It's not a fourth branch of government. You know, the Fed exercises congressional powers, you know, kind of end of story. And the Congress is not going to give that up. But when people see that, when people see that the net effect of what Trump and Vance are talking about is going to negatively affect their savings and their pensions in the marketplace, you know, that's a losing argument for that ticket.
Terry, another piece of policy that we could probably argue is a piece of meat being thrown out there by both candidates is this idea of no taxes on tips. Both of them have coalesced around it. Trump was the first to say it. Harris talking about it over the weekend. Where does that land us on tax policy for the two of them? What did you make of it?
Well, that's, yeah, we'll go back to where you started. It's a great little bit of meat, and sure, why not? You know, it lends itself to the immediate riposte that you know, well then, yeah, why don't we talk about income from whatever source derived and then start to make exceptions? I think once you get into, in the very unlikely event today that you get into an extension of the 2017 tax law, I say that because a split Congress, no matter who the president is, a split Congress with either House Democratic is not going to entertain an extension of the 2017 tax law. You know, I think that unless you get some sort of Republican clean sweep, this doesn't happen, because what ends up happening is that they want to capture as much revenue as they possibly can. So, you know, it's a little bit of enticement for people, but in the end, it won't happen, I don't think.
Terry, is the Trump conversation tonight with Elon Musk on X, formerly Twitter, probably going to be more of a liability or a boon for his campaign?
You know, I think on balance, it'll be a little bit of a boon, and it's worth watching for this reason. It's really about two things, I think. One is it's about kind of cross-marketing, right? I mean, you know, Musk wants to highlight a free speech platform, a freer speech platform, you know, from the background that that a lot of the social media were colluding with the government on things in 2020 and thereafter. It's also about rebranding the Trump campaign as the resistance. And that sounds like a leap, but you can see it in Musk's tweets, where he tweeted just yesterday or the day before that, you know, you see in movies, you know, and you identify with the resistance in all movies, Star Wars, Divergent, this, that, and the other, but you don't see it in real life. So I think what you're going to see here on this interview is a rebranding exercise where what Musk wants to do is attack the what he characterizes as the anti-free speech posture of the Harris-Walz ticket, and what Trump tries to do is tries to start the conversation around exposing Harris as more than a shapeshifter, but as just another politician who's taking whatever stands suit at the moment. So, you know, we'll see where it goes, but I think that's what you're going to get out of it tonight.
Terry Haines of Pangea Policy, thank you as always for your insights. And if you want to find the End the Fed crowd, Twitter or X is probably one of the best places to do that. Coming up, the latest on tensions in the Middle East with Bloomberg's Bobby Ghosh right now in markets trying to claw back some of the losses that last week were still a little bit left over. This is Bloomberg. So it sounds like it was really volatile. We saw the biggest spike in the VIX going back to the early days of the pandemic. We saw the yield curve uninvert for the first time in at least 2 years, and the S&P lost negative 0.04% in the week. Right now, people are trying to claw back and maybe even turn that a gain to reverse some of that volatility. S&P futures up about 0.2%. The NASDAQ clawing back some of the losses after some of the big tech darlings were thrown out with the bathwater. Maybe the first things to sell in a crowded unwind of a carry trade, up about 0.3%. Russell, interestingly, is lower. And honestly, I want to sit on this for a second, Danny. How much is this a growth scare versus actually an economics versus actually some sort of financial scare? If you see the Russell down 0.4%, even with some of the rate cuts priced in.
Well, the market certainly treated it as a growth scare. And I think it's fair to say this is not a recession, because after all, recessions aren't events. It's a process. You get there eventually. But I think when people were buying up the Russell to an extreme pace, a lot of us were questioning, do the economics back this up? Is this really early cycle and you can get all these cyclical companies and all this, let's be honest, unprofitable junk that's in the Russell 2000 to actually rally? Perhaps the past week was just a reminder that the economic environment is not ripe for that.
There's also this really key question is whether the rate cuts that are being baked into the market will be positive for equities or negative. If you switch to the boards and take a look at what we're seeing in the yield space, we are seeing a reversal of a lot of the decline in yields that we saw last week. Yields continuing to climb higher. Now, 2-year yields back again north of 4%, 4.05% after plunging about 20 basis points last week. U.S. 10-year yields 3.95, 30-year yields 4.23, and this came after a pretty poor 10-year and 30-year auction. Danny, to me, there really is this key question about whether the Fed actually is poised to cut by 50 basis points if you have the likes of Michelle Bowman coming out and saying, actually, pump the brakes, guys. I don't really see what you're seeing in terms of inflation falling off a cliff and growth really becoming the preeminent concern.
That is it. The market has moved on from inflation being the concern. It is concentrating on the Fed's other side of the mandate. And this is the big risk for bonds, that we are potentially still in an inflationary environment. How are you going to cut 100 basis points for the rest of the year if Fed officials themselves aren't even saying that they're ready to cut 25 basis points?
And this has been one of the questions as people maybe price out a 50 basis point rate cut in September, but another one later in the year with 100 basis points of rate cuts priced into the market right now. If you take a look at the dollar, to me, this really might be the linchpin of everything that was happening last week. And it's not really the dollar as much as the yen and what happened there with a surprise hawkish hike from the Bank of Japan and the subsequent sort of right sizing of that currency pair. Now 147.39 after being as high as 160, 170. A question now for the euro is whether it can continue to climb at the pace that it has over the past week, 109.26, given not euro strength, but dollar weakness because of some of those Fed rate cuts. Under surveillance this morning, a raft of key economic data out this week. We'll get PPI tomorrow, followed by CPI on Wednesday, plus another round of jobless claims and retail sales on Thursday. We'll also be hearing from key consumer giants in the retail earnings space, which is Home Depot and Walmart. What are you looking for, Emery? I mean, in terms of the most important indicators, particularly as it has to do with where the levers for the Fed really are.
So I feel like given the fact that the market is swinging, like yet last week when we got the jobs number, initial claims, they were acting like it was a real non-farm payrolls report. I think for the market, the data is going to be really important, especially when you hear the likes of Nikki Bowman talking about the fact that inflation still is key. But for me, I'm interested in what the consumer is spending on. When you look at Home Depot, these are big ticket items. There is a housing slump. How do they fare versus, say, a Walmart, which has said that it's now starting to see higher end consumers trade down into their marketplace? So I want to hear from these big companies on what they see on the ground from their consumers.
And I think you got to assume that that's what the market is concentrated on, right? Because of these recessionary concerns. The thing I'm looking out for is what if CPI comes in even just a tad hotter? Do we all of a sudden see this huge pushback from the Fed of the likes, again, to your point, which we're already starting to see, and that just continue into Jackson Hole? How offsides is this market if that's how this week plays out?
Which is some of the reasons why it might be a bigger week to actually watch some of the Fed speak as well, not just some of the economic data. Foreign investors, meanwhile, pulled a record amount of money out of China last quarter, the latest sign of pessimism around the world's second largest economy. The numbers are pretty shocking. Investors pulled almost $15 billion in the second quarter, the second time the country has recorded an outflow in data going back to 1990. This is according to state data from China. It just starts to raise this issue of how fragile, Emery, China is, and how that factors in not just in an economic picture, but a geopolitical picture, as you start to wonder how desperate they are to flood the market with goods.
And there's a question on whether or not these two issues are interchangeable. One, the economy slowing, and two, geopolitical concerns. Last week we got data, inflation rising very so slightly in China, but that was due to weather. There is still a serious demand concern, but the likes of Goldman Sachs says potentially the Chinese government is waiting on the sidelines, even though they put out this 20-point plan about fiscal spending, because they're waiting to see on the political front who wins the U.S. election.
Yeah, and this really goes to the heart of what even we heard from Michael Shaoul, Danny, which is that essentially this is one of the wild cards. Will they pump some sort of fiscal stimulus into the economy to create that kind of ballast to the global economy that right now is missing? And ultimately, how much are investors even counting on that at all?
Well, it's a philosophical barrier because you have President Xi previously saying that he doesn't want that Europe-type stimulus into the market. So it would be difficult for him, again, to backtrack on what he sees as a core principle for this Chinese economy. So you have all the stars aligning of geopolitics, weak demand, and not to mention local competition. You see this with the autos. Porsche really struggling in their earnings because all of a sudden China flipped to not just EV demand, but local and cheap EV demand. So it's all these things coming together that makes it unappealing for internationals.
Well, talking about geopolitical risk and some of what's heating up there, Israel right now is strengthening its infrastructure defense as it faces heightened risk of attacks from Iran or its proxies in the Middle East. This comes as Iran reiterates its pledge to seek revenge for the killing of a top Hamas official in Tehran. Joining us now is Bloomberg's Bobby Ghosh, and we are just getting a latest from the Wall Street Journal saying that the U.S. is planning to send a carrier and a missile submarine to the Middle East in preparation for the retaliation from Iran. Can you just give us a framework for what we're expecting in terms of what the retaliation might look like?
Well, so Iran keeps saying it will retaliate, and there was a statement overnight from the Iranian foreign minister to that effect again. Iran knows that it can't keep making these statements without actually doing something, because that undermines its credibility at home and with all its proxy militias in the region. It set a bar. Iran set a bar last April when the Israelis took out a senior Iranian commander in Syria. Iran responded for the first time by retaliating from Iranian soil. Remember, they fired off 300 missiles and drones in the direction of Israel. It was a bit of a showpiece. They gave Israel plenty of time to prepare. They gave plenty of advance warning. So no actual damage was done, but it was symbolic. But it set a bar. Now the challenge for Iran is calibration. It has to raise the bar. It can't not. This is Israel taking out an important target in Tehran. But at the same time, it has to calibrate to in a way that it doesn't set off a war. Iran does not want a war. None of these players want an actual all-out war because the damage from that is far too great. Their economies won't sustain it. So how do you raise the bar without actually getting into a war? The most likely scenario, and all kinds of defense experts are sort of looking out for this, which is that Iran fires off another volley of missiles, maybe more than last time, more than 300, from Iranian territory, simultaneously has its proxies, Hezbollah in Lebanon, Hashd in Iraq, and the Houthis in Yemen all also fire off a volley of missiles and drones and rockets. So it's a much larger number of it's a much larger aerial attack coming from multiple sides. The challenge then for Israel is, does the Iron Dome, the famous Iron Dome, is it capable of taking this multi-pronged hundreds of missiles from all over the place? One. And then the second challenge is for Israel's allies, especially the United States, can we then restrain Israel from going up one more notch? That's the risk. The risk here is not that any of the parties want a war. The risk is that we've reached a stage where any of the parties all too easily and unwittingly can blunder into a war. That's the real risk, that something will happen that pushes everyone over the edge. We are far too close to the edge now.
On Thursday, we're supposed to have these talks, but Hamas is not going to be attending.
No.
So what are these talks?
For me, these talks have now become a sideshow. It's very clear that Hamas is not really interested, especially now that they have a new leader, and the new leader is the guy who planned the October 7th attack, Yahya Sinwar. He's not a guy who's even remotely interested in any kind of peace and releasing the hostages, and he's perfectly happy to keep fighting till the last Palestinian. On the other side, it's very clear that Benjamin Netanyahu is not particularly interested in a deal at the moment. He's had plenty of opportunities and a lot of pressure from the Biden administration to make a deal. He just doesn't want to. And so these talks, I'm not holding my breath over them.
So do you see these talks, though, as domestic politics, or is it a Hail Mary event to potentially try to restrain Iran? So if there was a ceasefire deal, potentially that would mean Iran can hold off on retaliation.
I don't think Iran will be sort of moved by that. I think the Iranians, like me and like anybody else who's been watching the region closely, I think all of us sort of agreed that these talks are not really going to make a material difference. For Iran, the calculation is a question of just how much to do without getting into a war. I don't think the talks are for domestic consumption. From Israel's point of view, it's for international consumption. This is Netanyahu saying to the Biden administration, "You want me to keep talking? Look, I'm talking." Meanwhile, he keeps bombing schools in Gaza. They keep provoking the Iranians and Hezbollah. So everyone continues to do what they're planning to do, and they have this little thing on the side where they show the world, look, we're reasonable people. We're talking about peace.
I would say it wasn't that long ago that the Biden administration was talking about Israel crossing red lines and what that means for sending them weapons. And as Lisa mentioned, the latest story is sending, carriers and missile submarines over to Israel. Yeah. So what do we make of sort of the carrot and stick that the U.S. actually has to prompt any sort of response or any sort of de-escalation from Israel?
It's hard to take the stick seriously, the supposed stick. The Biden administration, again, I just saw a report before coming on air, is again now saying that we have made it clear to the Israelis that if they don't take these new talks seriously, we'll start naming and shaming them. I don't think they will. The Biden administration is briefing journalists in Washington off the record. Netanyahu is a past master at playing the bluff game on the international stage. The Bidens are trying to kid a kidder. That's not going to work. Netanyahu's not really paying attention to the rhetoric coming out of the White House. He's paying attention to the Biden administration's actions. And the actions are, we're sending an aircraft carrier group, a nuclear missile group. We're sending all the arms that Israel needs. That's all Netanyahu cares for. He knows for a fact, and he knows from long experience, that no matter what the occupant of the White House says, he did this during the Obama administration. No matter what the occupant of the White House says, there is a bipartisan agreement or consensus in the United States, in the Senate, in Congress, and in the political landscape in this country, that the U.S. will always back Israel no matter what. Netanyahu is counting on that, and it has never failed him before.
Bobby Ghosh, thank you so much for your insights. Always wonderful to get them. Hopefully we'll talk again soon of Bloomberg. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Bank of America CEO Brian Moynihan telling CBS the bank no longer sees a recession on the horizon for the U.S. economy. Moynihan going on to say consumer spending is slowing, but it's heading to normal. On the Federal Reserve, he said, quote, the Fed is in a position where they have to be careful that they don't slow down too much. Moynihan says the bank expects the Fed to cut in September and December. Former President Donald Trump plans to sit for an interview tonight on X with its owner, Elon Musk. The billionaire is promising an unscripted discussion with no limits on subject matter. Musk often butted heads with Trump when he was in the White House, but he endorsed the former president after the attempt on his life last month. Elon Musk's interview with former President Trump on X is set for 8 p.m. Meanwhile, President Joe Biden is giving his fullest explanation yet for why he decided to end his re-election campaign. In an interview on CBS Sunday morning, he described the pressure within his own party to step aside.
The polls we had showed that it was a neck-and-neck race, would have been down to the wire. But what happened was a number of my Democratic colleagues in the House and Senate thought that I was going to hurt them in the races. And I was concerned if I stayed in the race, that would be the topic. You'd be interviewing me about why did Nancy Pelosi say, why did so, and I thought it'd be a real distraction.
Biden is expected to join Kamala Harris on the campaign trail as soon as this week. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, it is all about the data.
We've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is. It's been a bit of a perfect storm of events, but I think that the growth scare has actually been building up in people's concerns for a while.
That's up next. This is Bloomberg Surveillance. Everything's over. People are on vacation. I'm back. John's off for the whole week. Right now, you're seeing markets claw back. Some of the losses from last week, they were pretty much all clawed back anyway, up about 0.2%. Really, this question of how much of some of the leverage trades really have been unwound and how much of the economic concerns are sort of rooted in reality. And under surveillance this morning, it is all about the data.
We've moved away from wondering, is the economy going to continue to accelerate? Is there an overheating? To people really questioning how weak the economy is. It's been a bit of a perfect storm of events, but I think that the growth scare has actually been building up in people's concerns for a while. If you were to see a continued deterioration in the data, well, the Fed themselves are going to have to respond in kind.
That is certainly what the market is betting on. Here is the latest, a key week of data set to provide further insight on the health of the U.S. economy and the Fed's ability to really cut rates. U.S. PPI coming tomorrow, followed by CPI on Wednesday, ahead of retail sales, as well as another round of key jobless claims on Thursday, which have renewed importance. Nela Richardson of ADP writing this. With all eyes on September's Fed meeting, CPI will be the most important indicator of the week or maybe even the year. Nela joins us now. Nela, I am thrilled to have you. We are thrilled to have you here in the studio, especially at a time where there's so many questions about what's actually going on in the labor market. You point to a slew of statistics showing that we are still above pre-pandemic levels of hiring. Does that mean that we are out of the woods? Is that basically a good reference point at a time of deceleration, and we don't know where the end point really is?
I don't think we can be conclusive with this data, but we can actually give context to what we're seeing. It's undoubtedly that the labor market is cooling. Everybody's talking about it, but we never say where we're cooling from and where we're cooling to. And right now we're cooling from really abnormal hiring levels. When you look at small firms, when you look at new business formations, we're going back to something that resembles 2019. Will we stay there? That's the open question. I can't give you a definitive answer on that. But the normal has recalibrated, and now normal looks a lot like 2019 with some interesting changes, like new business formation, which I point out in my blog this morning. We're seeing record numbers when you look at over the past 10 years of new business formations, even still. And about a third of those are high propensity businesses, which means they have the potential to actually add payroll and headcount. Those are the new employers. Those are the new job creators. And that's a little bit different than what we saw in 2019.
Before we get into that, and we will in just a moment, how much does this sort of undermine the conclusion that a lot of people had from the July jobs report that came out really disappointing and raised a lot of concerns about a recession and about the Fed potentially cutting rates by 100 basis points this year?
So what we're seeing is a market of investors and speculators that are overreacting to economic weakness and ignoring economic strength in the Main Street economy because they're not seeing it. They're not seeing the mom and pop hiring that we see in the ADP data. They're not seeing, and maybe not looking at financial conditions when it comes to small business loans. They're looking at the bond market. So to look at the economy in totality, yes, you're going to see some weakness, but you're also going to see some areas of strength. That's why this data week is so incredibly important, because not only will you see financial market indicators, you're going to get retail sales. You're going to get a sense of how Main Street is doing next to all of these price data that the market is following so closely.
Well, I think one of the difficult things for these markets is we're struggling what the recession indicator is. That things in the past, like a yield curve, SOM rule, as Powell says, are just statistical regularities, that this time is different. What should be the indicator? How will we know if we're heading towards that? Or is it like frog in a boiling pot of water that by the time we're there, we know we're there, it's too late?
If you really want to know the direction of the economy, you always look at the consumer. Is the consumer still spending? That's the data point that's important. And is the consumer still spending ahead of inflation increases, or are they spending with a little bit of tailwind at their backs with that inflation number going down? That's exactly what we'll see this week. And if you look at last month's data, consumers were holding the line. They were doing okay. And this is an okay economy. It's not super strong. It's not super weak. It's holding the line, and that's pretty good when you consider the inflation headwinds that we've all experienced over the past 2 to 3 years.
Well, to that point, Lisa started out with this idea that for you, CPI is the most important statistical point this week, despite a market that seems to have moved on from it. Why is inflation still important this week?
Because it really is important to the Fed. Now, it's not the preferred indicator. We all know that, but it is an indication. And I will also argue that PPI, that those producer prices, are actually gaining momentum in terms of interest, because people are going to be looking at PPI to see the through line, the pipeline to that very important PCE report that the Fed really cares about. So the fact that producer prices can bleed into consumer prices, super important, but it's just going to be one more piece of evidence that the Fed needs, that they're comfortable with cutting rates in September.
Last week we heard from Thomas Barkin, and he said there's no hiring, there's no firing. Basically, we're flat. But you are seeing a pickup of hiring in these smaller, less than 50 people establishments. What are you seeing? Like, what exactly businesses are these? What are they looking for when they go to the job market?
Right. So a lot of them are mom and pop Main Street businesses. So you're thinking about those consumer facing businesses, restaurants, bakeries, dry cleaners, those parts of the economy that kind of keep churning regardless of whether or not there are recession fears. And those employers were really blocked out last year as larger employers were still hiring in force. It really took some time for them to get a window into this labor market, this talent market. And you saw that pick up last year. Now they're normalizing, but they're still adding headcount. And that's a really important indicator. And I'll also argue that the demographics are changing the labor market. So with all these retiring baby boomers, not all of them are going to Corsica. Some of them are actually opening new businesses and becoming non-traditional workers in this labor market, contract workers. And that's going to be a change that we see going into the future, because they're not just becoming traditional workers. They're becoming business.
That was a shot for Lisa, not John, even though he's also he's off this week. Lisa was last week. When you look at the changing market,
I was anonymous. I was.
Oh yeah, big time. We saw where your eyes look, Nela. So when you look at these changing dynamics, it's not just the boomers potentially leaving the workforce. It's new flows of supply coming in with immigration. How do you view that immigration supply right now? Because some are saying that is the reason why we have to discount things like the SOM rules, and others are saying that some economists are using immigration too much of a point, and that there actually isn't as much as we're expecting.
Right. I mean, no one makes a better case for why this might be different for the SOM rule than Claudia Sahm herself, which she says, immigration is not anticipated in that rule. And so if you're seeing a pickup in immigration, and we have, it's to be expected that the unemployment rate, because it's been so affected by the wild swings in labor supply over the last 3 years, that would, see an uptick if we see more people coming into the labor market, lured by higher wage growth, which we've also seen in the labor market. So not to totally discount the SOM rule, but also to give room and breadth for immigration as part of that story.
Nela Richardson of ADP, thank you so much. Always wonderful to have you. Really interesting. And we talk about Claudia Sahm, and she wrote this piece last week on Bloomberg Opinion. You guys all saw it. I was out somewhere. And the title of it was, "My Recession Rule Was Meant to Be Broken." And I love her humility. She says, listen, the SOM rule joins a list of economic tools skewed by unusual disruptions of the past 4.5 years. That definitely is a sort of underscoring some of the
And Torsten Slok over the weekend picked up on this, saying the SOM rule was designed for a decline in labor demand, not a rise in immigration. We're trying to work through what exactly this means.
Although she then went on to say, that said, Danny, and I say this with a mixture of humility and concern, the SOM rule is still relevant.
All I would say is if most economists had something like this, they'd be beating the drum. Like, yes, I came up with this thing. It is right. It's happening. The humility is the best part.
I do love that. She keeps reminding people rules are meant to be broken. And then she says, I don't know. I can't decide. And I love that about her because ultimately that is the truth with all economic indicators. Coming up next, Tony DeSpirito of BlackRock, Scott Bessent of Key Square, Eric Resnick of KSL Capital Partners, and Deborah Cunningham of Federated Hermes. We're going to be talking about travel during a period of vacations.
The market tends to lead the Fed, and I think you're seeing validation of that now.
The thing which would really cause me concern is a significant fear of unemployment.
If the unemployment rate's going up, you can count on the inflation rate going down, and I think that's the trade they're going to make as they approach the end of the year.
My guess is they'll wind up being content with stopping higher than they stopped last time.
With the economy that's generally speaking slowing, the start of the rate cutting cycle, regardless of jobs, is here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Maybe last week was a good week to take off after all. I mean, what actually happened? Welcome back. Good morning. This is Bloomberg Surveillance. Today and this week, John Ferro is off. Anne-Marie Hordern and Danny Berger and myself all holding down the fort in the month of vacations. And we'll be getting to that in just one moment. But, Danny, I was thinking about this. Last week, what actually happened? Was this a matter of some fundamental rejiggering, or was this an issue of just no liquidity, or possibly the worst liquidity going back to the peak of the pandemic at a time where you had huge leverage unwinds?
I think that's so important. I was talking to a trader last week who said he was trying to look at options, and it basically looked like an emerging market, that the bid and the ask spread was so massive. And that gets to the point of people saying, can you really trust that the VIX actually went to 65? How do you actually calculate a measure like this when liquidity was so bad? But the fear, Lisa, is it could be all of those things. All of those things could be true, that it was bad liquidity, and there's been a paradigm shift in this market, and we're going to swing up and down as we try to find the new trend.
We're going to have to rehash the toxic brew of potential items that are coming to the fore. I am wondering, though, Danny, if that means that it will continue.
It very well could. But I guess the good news, Lisa, is bonds are doing what they're supposed to do during it, that you can have these big swings in equity markets and you can see bond portfolios gain. The question is, and we're talking with Michael Shaoul about this, are we prepared for that? Or did we all change our portfolios assuming that bond stock correlation had reversed forever?
So the first week that I was not here on vacation this summer, President Biden decided not to run again. He dropped out of the race. The second week, we had the biggest vol spike going back to the height of the pandemic. We had a couple of auctions and a host of market volatility that a lot of people have been waiting for. On the political front, Anne-Marie, how much are we looking at a really fundamentally changed landscape where Trump is on the back foot and Harris is riding high?
It's a brand new election. We've seen a paradigm shift, and the last few weeks feel like news that would happen in a decade, as well as you think about the fact that after the attempted assassination on Trump's life, the RNC, it was almost a foregone conclusion. And this is what Michael Shaoul was talking about earlier, and that was the Trump trade, almost a foregone conclusion that he would win, and markets were starting to price that in. Now, markets are taking a look at a very different setup, and actually a serious race with Kamala Harris now in some swing states beating the former president, Donald Trump.
I don't understand why the Fed suddenly has taken on such preeminence in this particular presidential debate, this presidential election. We've heard from now not only Donald Trump, but also J.D. Vance about how he thinks there should be more political interference in the Federal Reserve. Who is this catering to, Anne-Marie?
Yeah, he was doubling down on what Trump said. Trump last week said that he feels like he has a better gut instinct on where interest rates should go and that he should have a say. It goes back to that April report from the Wall Street Journal that said the Trump campaign was looking at ways the president could have more say. But Paul Donovan of UBS said this harkens back to a retro era of the Nixon administration, and the markets don't believe it. They view it as rhetoric, because if they did believe it, they would really start to react to it.
I also think the question of who is this for is really interesting. And I can't help but wonder if this goes back to what Terry Haines says, that the Republican Party wants to be seen as the party of resistance. And that means challenging a lot of institutions. And I mean, what bigger sort of staid financial institutions is there by the Fed? So maybe it's this kind of narrative that these institutions are doing you wrong and Trump is going to come in and change things and fight for the everyday man. Of course, in practice, it doesn't quite look like that and could be worse for the everyday man.
Well, and meanwhile, when we talk about resistance, he'll be catering to that message on X tonight with Elon Musk, Donald Trump. Meanwhile, we do have a massive week coming up, Danny. We do have a PPI, CPI, we've got Home Depot, we've got Walmart earnings, we've got retail sales more broadly. A real question here of how much volatility could hinge on the backs of some of these metrics.
I also think you were spot on in saying that the Fed response to it might be equally as interesting to the data itself. Because so far, the Fed has been saying it's still inflation. Bowman, Collins, all of them saying we are not there yet. We want to see inflation cool more. And it's a market that's already moved on from inflation, that already cares more about the other side of the dual mandate. So what happens if CPI does come in even just a tad higher? Do markets need to recalibrate? Are they prepared for that potential reality?
Make Fed speak great again. Right now we're seeing in markets a bit of clawing back after last week's drama that ended pretty much with a flat market on the week for both the S&P and the NASDAQ. Today you're seeing up about 0.2% on S&P futures. The dollar really front and focus after the unwind of a lot of carry trades tied to the yen. Dollar weakness expected on the heels of some of those Fed rate cuts. Euro strength, not because of the euro, but because of the dollar. 109.29, up about 0.1%. 10-year yields higher, clawing back again. Some of the declines that we saw in yield down about 20 basis points last week, 3.95 currently. And crude, after a 4.5% rally last week, up about 8% at $77.65 traded in the NYMEX. Coming up this hour, we've got Tony DeSpirito of BlackRock as investors prepare for a busy week of data. Scott Bessent of Key Square Group on the outlook for a possible second Trump administration. We can ask him about the Fed. And Eric Resnick, don't miss this, of KSL Capital Partners on the state of the consumer and the travel sector. He oversees all sorts of resorts, has investments in hotels, the Icon Pass, et cetera. And we're going to be having a week looking into what some of the travel sector is seeing with the health of the consumer as people wrap up their summer vacations. We begin with our top story. U.S. stocks looking to build momentum heading into a busy week of data for the investors and the Fed. Tony DeSpirito of BlackRock writing this: market focus moved from rate-cutting exuberance to recessionary fears. We have been saying for some time that we expect volatility to rise and the market to broaden. Tony joins us now. And Tony, great to have you. Thank you for being in studio. I believe this is the first time you've been in this studio. You're talking about how you expect volatility to rise and the market to broaden out. How much are those two ideas compatible?
Well, I think that's what we've seen happen, actually, since the beginning of July, both a broadening of the market, right? If you look at the equal weight S&P 500, it's outperformed, value stocks have outperformed, et cetera. So that's been the broadening. And then we've obviously had the rising volatility. And that's something we've been calling for a while now, because both of the phenomenons we've seen, extremely concentrated Mag 7 performance combined with very low volatility, is absolutely abnormal.
Which to me is compelling, especially because you wrote this, our approach more technical than fundamental. How much is what we're seeing purely technical, overcrowded trades, unwinding of carry trades versus fundamental weakness?
Yeah, so I think it's very much technical. Think about how we went into this. If you looked at June 30th, if you looked at a cap-weighted measure of momentum, it was in the 5th percentile over the last 12 months. That's extreme positioning. So we went into this with extreme positioning. And then a few things moved the market dramatically, right? I think part of it was the lack of liquidity that we see normally during the summer. You had the unwind of the yen carry trade. And the market has moved from, oh, this is great, the CPI is slowing, the Fed's going to cut, buy small cap value stocks, to, oh no, the Fed's behind the curve, buy min vol stocks and sell everything else. And that just doesn't make any sense. And when you look at the underlying fundamentals, yes, the economy's slowing, but in a good way, right? Through labor participation growing as opposed to layoffs. It's, if you look at the Fed Now measure, the Atlanta Fed, that looks pretty healthy. Earnings season's really good. So I think the underlying fundamentals are still very strong, and this is mostly technical.
So where does that leave us now? If we had this technical froth come off the top, you had credit spreads finally widen, you had the dollar yen did what it do, you had Japanese stocks selling off the most since 1987, and then a rally in the back half of the week. Right. So where do we stand in terms of stretched and frothy technicals?
Yeah, so I wouldn't be surprised if the volatility continues for a while, even through the fall, right? September and October tend to be volatile months. And then after that, I think as you get into the October earnings season and you see, oh, everything's still okay, I think that's when we'll see all this settle down.
Well, I know you say don't time the market, but in some way, should I see every time stocks drop like they did, do I need to lick my lips and say time to buy up?
Yeah, I do think when you get a decline of 10% or more, which happens, is not uncommon. I'd say once every other year you get that kind of event. That's typically been a buying opportunity. So yeah, I do lick my lips when I see that, and I do get excited.
You say in your note that you want to take this more discerning view of the market. This potentially can be a stock picker's dream, what we're seeing right now. What industries are you looking at?
Yeah, so when I think about stock picking, I think about skill and volatility, right? The more volatility, the more you can apply your skill and make money. And so I think there are a lot of interesting sectors right now. If you look historically at Fed rate cuts, one thing that always works, or has always worked, I should say, has been quality and low beta. And right now I see a lot of low beta stocks. They're actually pretty attractively priced. Healthcare, staples, even utilities.
Okay, so we have the Fed rate cut, but then after that it's going to be a U.S. election. Do you position differently for politics?
I don't think you can. I think you have to look, and yes, there are certain sectors that may be at risk if one person wins or the other person wins the presidency. But for the most part, I think what you want to do is avoid that kind of risk and just go straight up the middle.
When you start to look at some of these opportunities that benefit from rate cuts, how concerned are you that we've overpriced some of the potential depth of rate cuts, certainly this year and even next year?
Well, I think one of the nice things that the Fed has set up here is by raising rates to over 5%, you really create a lot of room to cut, right? And so I think the Fed now has a lot of cushion. And so we could get a number of cuts over time. And that's kind of what the market's expecting.
How much, though, does this really hinge on CPI? And this is the reason why we heard from Nela Richardson that this is one of the most important moments going forward, simply because on one hand, you've got growth concerns. On the other hand, you have the Fed's inflation mandate. And if inflation doesn't cooperate, it really ties their hands with how much they can use that lever of cutting rates. How much, if we got a hotter than expected inflation read, not just this time, but also over the next couple of months, how much would that shift your view?
Yeah, so I think that would definitely give the Fed pause. But remember, the Fed's going to look at both the economic data and the inflation data. And if you go back to 2007, right before the global financial crisis, in 2008, inflation was still really high. If you remember, oil peaked at 140 in June of 2008, and then the Fed was cutting despite that. Why? Because they were worried about the economy. So if the Fed got really worried about the economy, they'd cut even with inflation. They'd look at it as a lagging indicator, not a leading indicator. I don't think we're there.
Tony DeSpirito, thank you so much for being with us today. Don't be a stranger of BlackRock joining us here in New York. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Hakez. Yahira.
Hi, Lisa. The CEOs of Britain's biggest companies received record pay last year, but a slower pace of growth saw the gap with the U.S. widen. Median pay for FTSE 100 CEOs edged up 2%, just over £400 million, but that's well short of the 21% increase they saw a year earlier. Median pay for CEOs of S&P 500 companies, meanwhile, were up 12.5%, according to data provider ISS Corporate. Oil prices are extending their first weekly gain since July, climbing back above $80 a barrel. OPEC is trimming forecasts for global demand this year, but it still remains above industry consensus. This coming as traders continue to monitor Iran's expected response to last month's assassination of a Hamas leader in Tehran. Meanwhile, OPEC is still expected to raise crude production in the fourth quarter by roughly 545,000 barrels a day. And Disney announcing a new villains theme land is coming to the Magic Kingdom Park in Orlando. The exact opening date and details remain in the Disney vault, with the company only releasing this concept art. This is part of the $60 billion investment into the parks the company had previously announced. On Surveillance last week, Disney CFO said that weaker demand for the parks is expected over the next few quarters due to economic constraints on the consumer. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Did you guys hear that story about people visiting theme parks more frequently, in part because the wealthier consumer is going overseas and the consumer with less income is keeping their money?
Disney CFO said that they actually expect the parks to do better next year because the high-end consumer is jetting off to Europe and they want them to come back.
They want to come back to Mickey Mouse and Donald Duck. Up next, politics facing the Fed. That is coming up next. This is Bloomberg Surveillance. heading into another week of likely volatility. That is what we're hearing from everybody who has come on this show. Right now, we're seeing just mild gains on the S&P, although building on that, up almost 0.25%. 10-year yields just marginally higher, and crude still with a lift on geopolitical concerns. Under surveillance this morning, politics facing the Fed. Here is the latest. Vice presidential nominee J.D. Vance backing Donald Trump's call to let presidents influence monetary policy. Trump has continued to push the idea after a news conference at Mar-a-Lago last week. Vice President Kamala Harris has maintained that Fed policy should be independent of politics. Joining us now is someone who really has inside knowledge and is a wonderful macro investor who has a ton of respect. Key Square Group founder and CEO Scott Bessent. Scott, thank you so much for being with us. I want to start with that, the idea of the Federal Reserve and its independence. What do you make of this actually being such a hot topic on the presidential campaign trail?
Well, I think it's kind of a canard that the financial press has blown up. All presidents want a say, and I think they have a right. Donald Trump is going to make his opinions known. I think Senator Warren, before the Fed decision, recently, the day before, said they should cut. The day after, she came out and said they made a big mistake not cutting, and I think that's within her right. And I'm not sure what all this is, or what this allegedly means that people are saying Donald Trump thinks he should be in the room. If he wins, he will get to choose a new Fed chair. The Treasury Secretary meets on behalf of the administration with the Fed chair every week, so the administration's opinion is known. And I've written and talked quite a lot about, I already think politics are in the Fed because I think Janet Yellen's taken over the Fed.
Scott, though, when it comes to what Trump is saying, and J.D. Vance really doubled down on this yesterday on CNN, he said that fundamentally it should be a political decision, agree or disagree. Doesn't that thwart the independence of this institution? And haven't we seen that in the past under Nixon, and it didn't exactly work?
Well, I think it's all up to the Fed chair. And, the president, he or she, always has input. We saw from Joe Biden, State of the Union. I'm expecting a Fed cut. We saw a week later in Philadelphia, I'm expecting a Fed cut. Then the inflation numbers got hot. Oh, I'm expecting a Fed cut, but just a little later. So, presidents, make their wishes known. And, I do want to comment, I think this Wall Street Journal piece that referenced a 10-page document, I would challenge them to produce that 10-page document. I do not believe that document exists.
Okay, well, I just want to dig into something that you said. You think that Janet Yellen has already taken over the Fed. I wonder how much this is really in reference to the fact that the Treasury Department has been selling a disproportionate amount of T-bills. Some people say it's been offsetting some of the quantitative tightening, as well as what we're seeing with respect to rate hikes over the past few years. How much do you believe that the Fed is way more political than people expect, and that is something that you can trade around even?
Well, look, what I've been able to trade around, and we'll go back. Your question on Yellen Treasury, highly political. Unfortunately, Secretary Yellen has thrust herself into the middle of a campaign in a very inappropriate way. She gave a highly politicized speech in Arizona a couple of months ago. She was standing on stage with the governor of Pennsylvania campaigning for Kamala Harris, who is not even, her president, 2 weeks ago. So it is politicized. The quarterly refunding schedule was changed for the first time ever. They gave forward guidance. So how do you know what the conditions are going to be? Why do you have a Treasury borrowing committee if you are going to give forward guidance? So to come back to the Fed, look, the Fed, I think they try to keep politics out of it. We all have biases. 93% of the people at the Fed are registered Democrats. But I think in general, that they are doing what they can with what they've got. Your question in terms of how do I trade around that? I've actually had very good luck this year trading against the Fed. That anytime they publish their so-called dot plot, the SEP, the Summary of Economic Projections, they've been wrong. So for all year they had 3 rate cuts. I didn't think there'd be 3 rate cuts. Then at the June meeting, they published that there would only be 1 rate cut, and we traded against that, and that's proving to be wrong because now the market's pricing in 3, maybe 3 jumbo rate cuts.
Scott, if we could look into some policy that has to do with the Fed and the Treasury. It's well known that you're one of these individuals that talks to the former president, potentially could be part of his future team if there's Trump 2.0. He gave an interview with Business Week and talked about a weaker dollar. How would he see that through?
Look, I think that's a preference, not a goal. That I think he believes, and again, I think about it more in terms of, are other currencies undervalued? Is there some kind of a manipulation, i.e. the Bank of Japan running, ultra loose monetary policy for 12 years and doing a gigantic depreciation of the yen where it goes to, a 50-year undervaluation? Is there something that the Chinese are doing with their trade policy that is causing an artificially weak the RMB, versus a strong dollar? So, I think remedying, these undervaluations as opposed to remedying, a strong dollar is a better way to think about it.
Well, probably no one would like that more than Japan. I mean, they have not liked the weakness that they've seen in their currency. So do you foresee something like a Plaza Accord? Is that what we should be looking at? Should there be a Trump administration with these, again, specific currencies, renminbi, yen, to right-size some of the inequilibrium that you're talking about?
What was your question? Should there be a Mar-a-Lago Accord?
Mar-a-Lago Accord. Sure, we can call it that. Why not?
Well, I think that's what it would be called. That I could see, something, or a policy, specifically targeted at the different countries that are in violation, maybe rather than a global, thing like Plaza and Louvre was. If you go back and look, I've studied this a lot. What's different this time is if you go back and look at the history of the Plaza Accord, the Louvre Accord, the Soviet Union was never mentioned because their economy was so small. So you had, a security threat and then an economic threat. Now with China, I think we should view China as both a security threat and an economic threat, and it is going to require a lot more finesse with them just because they are such a big part of the global economy. So you don't want to upset the apple cart, but you want to be prudent in terms of supply chains and national security.
How do you then view a weak dollar, though, if Trump is saying that he's going to put up the walls for the tariffs, 10% ring around the United States, 60% of imports coming from China, as well as what he says, mass deportations?
Right. So I think we've discussed this before. President Trump speaks in a different way than many politicians. He speaks like a New York City real estate developer, and I think that is the opening, the gambit. I've used the term, it is a maximalist negotiating position. I think a lot of the analysis around this in terms of inflation has been quite sloppy. At our firm, we try to, have better models. And, our models show that A, those are maximalist positions, and B, everything that I've seen, in sell-side research and other firms and commentators, assumes that there is a jump on day one, which will not happen. I have spoken to the president, spoken to his team, and I think everyone is on board with a kind of forward guidance or a phased-in tariff. So, here's President Xi, here's 60%. It might be 2.5% a month for 24 months. Tell us when you've had enough. And, at the end of the day, I think that Donald Trump views tariffs as a way not to, as an end to free trade. If you bring down your tariffs, we will bring down ours. Recall that at the G7 meeting when he was president, he left Ottawa to go to North Korea, and on the way out the door, he said to all the leaders, "I'll get rid of my tariffs if you get rid of yours." So I think he views like the tariffs as, kind of negotiating, almost like a sanctions policy.
Well, Scott Bessent of Key Square Group, will you be living in Connecticut or will you be living in Washington, D.C. next year? We will find out. Scott Bessent, you'll have to come back, of Key Square Group. We appreciate it. Coming up next, Eric Resnick of KSL Capital Partners on the Travel Outlook. We're going to be talking all about what trends are existing in the consumer after years of record travel amounts. Are they tired or are they continuing on their adventures? This is Bloomberg Surveillance. Welcome back. This is Bloomberg Surveillance. After a week of tumult and unwind in terms of leverage trades, we are seeing some stability in markets pretty much across the board, looking sort of similar to where they were before I left for my week-long vacation that I will never get teased about. However, we will be talking all about vacation and where people are going and what that means for the state of the consumer in just a moment. Under surveillance this morning, Republican Vice Presidential candidate J.D. Vance floating a $5,000 federal child tax credit. This would more than double the current level, and Vice President Kamala Harris joining former President Donald Trump's calls to end taxes on tipped income. Just quickly, Anne-Marie, how much can we really give credence to anything anyone is saying at this point? Is this basically, as we were just hearing, red meat being sort of, dropped in bits to try to cater to certain groups of voters?
Well, there's that. And there's also the fact that Terry Haines, and he brings up rightly so, that none of this really matters until we know the makeup of Congress, because you need Congress to enact some of these policies they're talking about. I thought it was obviously so interesting that both Trump in June, Kamala Harris over the weekend, they're in Nevada talking to an industry where there's lots of workers that make money on tips, talking about this idea. But actually, when you look into some of the data behind it, and we have some analysis on this, from Budget Lab, they said a meaningful share of tip workers represent less than 4% of all employment in the United States. They already pay no federal income tax because they earn less than the federal minimums. So what this potentially could do, though, and what a lot of people talked about when Trump brought this up in June, is that some lawyers, hedge fund managers, could potentially make fees, taxes, and actually then they can usurp around this.
Yeah, I mean, this sort of goes to the question of what are we actually hearing in terms of policy. Meanwhile, Bank of America CEO Brian Moynihan telling CBS that the bank no longer sees a recession on the horizon for the U.S. economy. Moynihan going on to say consumer spending is slowing, but it's heading to normal, adding that the team expects the Fed to cut in September and December, not talking about that 50 basis point rate cut that a lot of people are talking about in markets. Danny, to me, this is the divergence that we're hearing and seeing from every guest who has come on this show. You take a look at markets, they're freaked out, they're whipsawed, they're also over-leveraged, have been overconfident, and basically over-leveraged this idea of a soft landing. In the real economy, slowing, but not slow, everything is chugging along. And that is what you're hearing from pretty much economists and investors across the board.
It's the pendulum, right? To we're going to have a recession to, jobless claims surprised by 7,000 people. Therefore, we're not going to have a recession. My favorite thing of what Moynihan said was we have to be careful that we don't try to get it so perfect that it actually puts us in a recession. It's this idea that the Fed can be preemptive. He's saying they don't need to be reactionary, that things aren't falling off a cliff, but they have the luxury of being preemptive. So they should cut. It's this idea, again, that recessions are not an event. It is a process. And again, he doesn't think we're in a recession, but that doesn't mean we can't get there. So maybe the Fed is behind the curve and they should be moving.
I love that. Embrace the mess. Life is messy. It's okay. You don't have to be so perfect. A busy week of data ahead with PPI and CPI on deck. Investors also waiting to see results from Home Depot and Walmart. We're also talking a lot about some of the retailers catering to vacations. We saw that last week with earnings coming out a bit softer. You do see certain numbers coming down in discretionary spending, definitely coming off the boil. Eric Resnick, co-founder of KSL Capital Partners, is focusing on the consumer and the outlook for travel and joins us now. And Eric, first, so great to have you on the show. Thank you for being here.
Thank you.
And your firm oversees tons of some of the most popular names that people go and visit, whether it is, the icon passes of ski lovers or whether it is the Marriotts and the Ritz-Carltons and the Four Seasons that people attend. Do you think that there is too much pessimism right now about this sort of pace of spending, particularly on the discretionary front?
I think there's too much reactionary thoughts happening based upon short-term data. When you look long-term, and I'm really here to thank you for being a customer of the Icon Pass. I'm on a swing. I'm on a swing thanking each one of our customers personally, and this is my morning to thank you.
Okay, you can call him up if you've got an Icon Pass. And
That's right. I'm here. Yeah, feel free to call me. No problem at all.
Okay.
But the long-term trends for travel are really positive. People don't realize how actually resilient travel is, even in the face of economic volatility. You know, we make what you were just saying. We have to embrace the mess. Life's messy, as you were saying, and the reality is, in that mess, what do? You want to escape. You want to be able to have special memories and experiences with your friends and family. So we see the long-term trends being favorable. We do see the same type of softening of trends. It's still fine, still good, but it's not as robust growth in some of the segments that we invest in that we saw over the last 2 years coming out of COVID.
I guess that there's a bigger question. We were talking about this with Nela Richardson of ADP earlier this morning, and she was talking about how the pace of job creation is actually still above 2019. You can point to similar types of trends in travel. People still spending more on travel now than, say, 2019. Is this the new normal where we can expect more spending at an accelerated pace, or are we going back to the old normal where people actually had to work?
Well, the have to work thing is an interesting one. I do think that the trend of remote work, of people having leisure trips, we were just talking about this on the break, combining purposes of trips, I think that's all positive for travel. Because when you want to combine things, what do you tend to do? You're combining something that's vacation-oriented or recreation-oriented with what you're doing at work. So we see, skier visits, for example, are growing more rapidly midweek than they are on the weekends. Well, that's a better experience for the guests. It's better for everybody. I'm not sure about people saying they're working from home on Friday, if we know that skier visits are up disproportionately on Fridays. But be that as it may, we're pro that. So I think the new normal is, we're all on all the time. We want to combine purposes and be more efficient with what we do. So I think in the end, that's probably good. It probably creates more balance for people, and for us, it creates more opportunity for them to vacation and recreate and do those things that we certainly like to invest behind.
I just have the vision of someone like with their laptop on a ski lift, blurring out the background, saying, "Don't pay attention to the wind swinging back and forth," and what you're saying.
Right.
But so you're talking about this, the trend and the spend and how much that is normalizing. What about just what people expect when they go to a luxury hotel? Has something fundamentally changed after the COVID era of not being able to get out, and they now want something different with their hotel experience that they didn't before?
I think that's fair. I think they want to have more than just your basic hotel experience. During COVID, we saw an expectation that it's okay to reduce services at hotels, right? We couldn't staff, we didn't want to have physical contact, so we eliminated some of those things. That type of expectation has now come back, but the guest wants more than that. They want to be able to go on a trip. Business travel is different, but for leisure travel, they want to be able to go on a trip and have more meaning. So for some, that meaning is wellness oriented, and they want to do, it could be as simple as a spa treatment. It could be something that's more holistic in terms of mental health, or it could be something physical, right? So I think the consumer, they just want more out of everything that they do. They want to feel that that's value.
What does that mean for the Airbnbs of the world? Where do they fit into that? Because they're not exactly providing that kind of service.
They're not. I mean, Airbnb and others in that business, they are trying to wrap around experiences. And you see experiences is a watchword that you hear on whether it's earnings calls or you see in consumer conversations. But I think Airbnb has that challenge, which is it's great if you're in a city because I don't need the restaurant necessarily or retail experience to be in my hotel in New York City. It's the city is my canvas, is my resort. But if you're in a resort destination, you want those amenities. That on the one hand, Airbnb offers wonderful value because you're getting more space and you can cook your own meals and congregate easily at your home. But it doesn't have the amenities, and I think they're trying to address that. And I think they'll have some success doing that, which is good for the consumer and I think good for the business.
Where are travelers going right now?
I mean, you're seeing a bit of a dichotomy in that Europe is hot, Japan is hot, currency is part of that. Part of that is you took international away, right? What happens when you take something away from someone? I mean, if you're a parent of teenagers, you realize this. You take something away, they want it more. And COVID took international travel, especially, away from us. And with currency or the U.S. dollar being strong and foreign currencies being a bit weaker, combined with coming out of COVID, you're seeing a lot of the luxury consumer want to go to Europe, want to go to Japan, and so that's creating kind of a normal not yet a normalization of travel patterns. I expect that we're seeing in some segments, but the consumers, the more budget conscious consumer is cutting back a bit more right now. The luxury consumer is going more abroad. I witnessed, Lisa going abroad last week, but the not to out you there, but
it's okay. Everyone's doing it this morning, so why not? Carry
first day
on.
back from vacation. It's what we all do.
Okay.
So you're seeing a real bifurcation in where consumers are going.
A bit. If you look at like select service spending for hotels, those trends are a bit softer than the higher end. In the last year, you saw RevPAR for more luxury travel to be positive still, 3-4%, while select service RevPAR is down. And I think that's indicative of that. But again, it's not dramatic, right? These are evolutionary, not revolutionary shifts in consumer behavior that we're seeing. Normal volatility, not abnormal volatility.
One thing that you have is a really good lens on what the balance sheet equation really looks like right now, especially at a time where we are talking about increasing oil prices maybe on the margins. You see increase in commodity prices. You talk about how suddenly workers and that sort of consumer experience is much more important. How much are margins getting squeezed?
If you look over the last 4 years, or I guess now 5 years since pre-COVID, 2019, our margins are up. We've been able to move price more than our costs, even though costs are up a lot, right? I mean, the average worker wages in our sector are up probably 20% in the last 4 years, which is a lot, but price is up 20 to 25%. So that equation still works. I think if you have less distinctive properties or less distinctive experiences, you don't have that same pricing power, and margins are being hit more. And that's a challenge. I think right now, if you look at urban hotels, their margins are under a lot of pressure still. It's getting better as the business traveler has been coming back, but it's something to watch out for.
Are you seeing hotels trying to spend to be able to deliver that? And then what does that mean for margins? If in order to get the larger margins, you need to have this all-around experience, but to get the all-around experience, you have to build a lot of capabilities.
Like everything, it's a paradox in life. I mean, you have to be able to do two things at once, right? And so I think hotels that have the ability to spend on the consumer experience to create more differentiation and therefore, justify a higher price to that consumer because they're providing that value, they're doing that. I think you see that. But other hotels that don't have that ability, I think they're seeing more challenges. We're seeing that. We've got some wonderful resorts in Italy, in St. Bart's, that they put tremendous emphasis on the consumer and guest experience, investing in spa, programming, wellness, off-site activities, picking you up from the airport with a great car, those types of things at the luxury end, right? They're seeing prices that are exceptionally high and still able to push prices. At the other end, if you're a more nondescript hotel, I mean, it's tougher today because the consumer is being more discerning in how they spend their money.
So you talk about bleisure, which is a difficult word for me to get my head around. Bleisure. It's fun to say, actually, and how increasingly businesses are mixing business with leisure. What's your life like? I mean, do you basically just go around and just experience the different experiences that your properties have? And you just basically go there and you say, I need a spa treatment to really understand the value that you're providing.
Yeah, that massage wasn't quite as good as it should have been. So, I need to do another one.
Exactly.
Yeah, it's a lot of that.
Yeah.
It's not as interesting as you would like to believe. Business trips do tend to be to probably some more leisure-oriented destinations than most, so it's fortunate in that regard. I spend a lot of time talking to the leaders of our businesses. We have about 25 business leaders across our portfolio. I spend a lot of time meeting with investors, meeting with other owners or constituents in the travel and leisure business. It's a large and growing sector, right? It's the third largest sector of the global economy. It's 10% of global GDP, 10% of global employment. But you have to stay connected to the ground of what actually is happening. Not quite the massage and the spa, although I try to partake in that once in a while. But I try to get a sense of what the consumer is looking for. And so I spend a lot of time on the road. And a lot of time trying to understand consumer trends, investor trends, and the mindset of our management teams and the challenges that they deal with day to day.
And on the ski slope on a Friday to see how many people are working
on
from the slopes. Eric Resnick of KSL Capital Partners, thank you so much for being with us. Truly a pleasure having you here.
No, thank you. Thank you all.
Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Lara Hackes. Lara.
Hi, Lisa. Foreign investors pulled a record amount of money out of China last quarter as they continue to sour on the world's second largest economy. Outflows reached $15 billion in the last quarter, just the second time the country has recorded negative numbers, according to China state data. Should the decline continue for the rest of the year, it would be the first annual net outflow since at least 1990, when comparable data began. Scotiabank has agreed to buy a minority stake in KeyCorp for about $2.8 billion. The move is part of an effort by the bank to increase its footprint across North America. Scotiabank will acquire just under 15% of the Cleveland-based bank, with shares purchased at an 11% premium to their volume-weighted average price. KeyCorp has about 1,000 U.S. branches and oversees about $187 billion in assets. KeyCorp was among the hardest hit regional banks in last year's crisis after the Fed hiked interest rates. And a mix of economic uncertainty and a weak period for earnings forecasts is likely to cap stock market gains. That's according to Morgan Stanley's Mike Wilson. He expects the S&P 500 to trade in a range of 5,000 to 5,400 as he sees macro data flashing no clear signals over the short term. On top of that, Wilson says we're likely to see analyst profit downgrades outnumber upgrades in line with seasonal weakness. His counterparts at JP Morgan also said they expect a mixed outlook for stocks through the summer months. Get ready. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. We're going to take a poll about whether people think it should be bleisure or lisness in terms of blending business and leisure. Up next, not that, testing the soft landing thesis.
Up to 5 cuts by the end of the year with only 3 meetings to go. That seemed, massively excessive. The market massively overreacted and it completely priced the Fed wrong.
That's coming up next. This is Bloomberg Surveillance. Let's check out what's going on with the bond market, because last week it was rather volatile. This week we're seeing a bit of a retracement back to lower levels than where we were before the vol freak out. What are we going to call that?
I don't know. Vol-mageddon 2.0, no, it doesn't work.
It doesn't work.
We need something that's akin to bleisure. I don't know how we're going to make it work.
Bleisure, we'll try to name that and coin that. If you have ideas, please write in. Right now you're seeing for the 2-year yield 4.05%, with people expecting a likelihood of 100 basis points of Federal Reserve rate cuts this year. Under surveillance this morning, testing the soft landing thesis.
Up to 5 cuts by the end of the year with only 3 meetings to go. That seemed, massively excessive. The market massively overreacted and it completely priced the Fed wrong. But it's obviously going to take a bit of time for this to be priced out. We're looking for the CPI data this week, Jackson Hole next week, and we may need to see some more data, especially the next labor market report, for that to actually, be removed from the market pricing.
Here's the latest. This week's major data points, PPI, CPI, and retail sales, are set to test the idea of a, quote, soft landing for the U.S. economy. U.S. growth fears are beginning to unwind, but traders are still considering the potential for an economic slowdown. Bloomberg Economics expecting soft inflation prints, but for retail sales to show consumers pulling back. Deborah Cunningham of Federated Hermes joins us now. Deborah, I want to just get your sense of how much of what we're seeing in the bond market was a reaction to true fundamental economic concerns versus a similar kind of overweighting of the soft landing thesis and just sort of an unwind of crowded positions.
I think it was much more of the latter, Lisa. It was definitely an overreaction. We saw something similar at the beginning of the year, 2024, when, we came into the year and for most of the fourth quarter, we were pricing in, I think, almost 7 cuts, 6.9 cuts at one point. And a similar reaction, I believe, has occurred over the course of the last several weeks. Now, thankfully, by the mid part of last week, the market had maybe regained a little bit of its sensibility. Some Fed speak had come into the picture, sort of, talking back the market from that overreaction. And we saw some retracement occur. Not enough from my perspective, but, better than it was at the beginning of the week and the end of the week before that.
What you're saying is actually really important, especially given what we heard from Michelle Bowman, really pushing back against the market and saying, you guys, inflation is still very much a concern for us and don't get ahead of yourselves. How much do you think that the market is still, and this is what you're basically implying, that basically maybe sell on the margins some of the treasuries that have gotten bid up most, just simply because there is more to retrace in terms of yields going higher?
Absolutely. That's our mantra at this point. If we can take some gains, if gains are available, which they should be and are in most instances, it's probably a good time to do that. Although maintaining duration and maintaining weighted average maturities is also a goal. So maybe, we've been looking at it sort of in the context of a barbell where some of the longer dated paper, provides more gains, whereas some of the shorter dated paper maintains some of what the current Fed stance is, which we think is appropriate. So, maybe maintain with somewhat shorter paper than you would maybe like to do at this red hot moment in time. But with an overpriced market, we just don't think that's the right strategy to buy longer at this point.
And Deborah, as you say, in the meantime, you're getting these big swings on pieces of data like ISM services, on jobless claims, things you usually wouldn't associate such big swings with. What does that tell you about what this week is about to look like when we get tier one data in the form of PPI, CPI, and retail sales?
We are very much ready for volatility. Volatility seems to be the name of the game. It seems to be what the market wants to do right now. It wants to react to every small piece of data, overreact on what I'd call maybe the upside from a standpoint of let's call it the downside, from a standpoint of, potential growth slowdown, hard landing versus soft landing, potential recession versus hard landing, and less reaction on, sort of the normalcy that I think the Fed is trying to gain. But nonetheless, I think what that means is volatility. So there's opportunity in volatility, and that's essentially what we're looking to find, with every day's trade.
Part of that normalcy, which the Fed is trying to talk about, is concentrating on inflation. This is something that Lisa had pointed out as well. So if we do get a hotter CPI this week, Deborah, does the market have an ability to concentrate on it again or care about it again? Or has that just too far gone and we're going to try to bully the Fed in trying to care about labor markets?
Bullying the Fed never works. So hopefully that, is not the tact of the market. I think it needs to be constant reinforcement with not just a CPI print, but maybe some additional, sort of less important, but nonetheless additional data that is confirmation of, what we're seeing from an inflationary perspective. So I do believe the market is capable of it, but not in a single print of a single number.
Deborah, what does that mean for where you see yields here? Because that is something that could potentially send yields much higher than they are at the moment, if that is a concern, if inflation still needs to be a worry.
I think that's where we need to see the market go. I think what has happened from a bond market perspective is overdone. And we saw some of that retracement last week, but I think there's more of it to come.
Just to put a bow on this, Deborah, we were talking about how a lot of people are relieved to see bonds acting as a haven once again during periods of volatility. Are you saying not so fast?
We are saying not so fast. Maybe, absolutely the Fed's next move will be to decrease rates. And maybe instead of that being one or two, and not starting till maybe November or December, maybe it's moved up a little bit. It's more like September. But it's certainly not intermeeting moves. It's certainly not 50 basis point moves. And as such, I think that's why there is, some retracement that continues to need to be done. But nonetheless, I still think, yields over 4% and maintenance of those for a period of time is of good value.
How many rate cuts right now do you expect for the remainder of this year, given the fact that you think 100 basis points is probably overdone, and it sounds like you don't think it's very likely that the Fed will go 50 basis points in one meeting?
I don't. So we're looking really at 50 basis points for the rest of the year. Outside chance of 75, but unlikely that even that will occur, because I think the Fed does not want to signal that they're wrong and that there's a bit of a panic and that they need to move faster than anticipated, unless they truly believe inflation is under control and the market is slowing in a way, the economy is slowing in a way that I think at this point is not expected.
Deborah Cunningham of Federated Hermes, thank you so much for being with us. As always, really interesting to me, this idea, Danny, that pretty much across the board, whether it's stocks or bonds, people are saying that it's more technical than fundamental.
Yeah, and what does that mean if you have a long-term vision of where these markets should go? You almost have to put that to the side because you can be really punished in the meantime. Just hearing what Deborah's saying, this idea that yields could be higher, that we could be over 4%. It's a bad time for that because the whole market just moved long treasuries. JP Morgan's survey of clients just moved to the most long treasuries since April. It is this pendulum swing that keeps going back and forth, and it feels like we keep, to the Wilson analogy, running on both sides of the boat and getting sort of crashed out every time we move.
And it raises a question about what liquidity means, because when you actually look at the trading volumes, they're at incredible amounts. They're at record paces for treasuries, for a whole host of other instruments, and yet the actual moves and the gapping out in bids would suggest a very different type of backdrop. Coming up next hour, Venu Krishna of Barclays, Daniela Bretthauer of HSBC, Lara, Rhame of FS Investments, and Jane Foley of Rabobank with an interesting change to her call regarding euro strength on the heels of some of those Fed cuts. This is Bloomberg.
Now that we've priced in these greater odds of the recession, I would say the market is probably going to be more sensitive to any sort of positive surprises.
That might be part of the problem, in that we are being whipped around on every single cyclical data release.
Financial markets aren't as important as they think they are.
In my outlook for equities, it does not figure prominently what the Fed does one way or the other.
They ought to be, and I think they will, erring on the side of caution if we do get additional negative data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back. Heading into a big week made even bigger after last week's turmoil. This is going to be a fantastic week of CPI and PPI data as well as earnings. We have Anne-Marie Hordern, Danny Berger. I'm Lisa Abramowitz. I am playing vacation tag with Jonathan Ferro. His week is this week. He is off for the week, but he will be coming back after that. And Danny, to me, this is really such an interesting moment where people are wondering how much of some of the turmoil of last week really was driven by fundamental weakness.
And you get the feeling that this week will serve as a reality check on that. Was that micro crisis justified once we get all this data pouring in? Because markets end of the week, as we've been saying, basically unchanged. But the volatility itself is important because volatility tends to cluster. And are we in a moment where each piece of data we're going to get this week, which there's a lot, we're going to see big swings up or down?
And this has been a massive week and a massive couple of months politically. We are about 2.5 months, less than that, until the U.S. presidential election, at a time where some people are saying that was what was behind last week's turmoil. Part of it anyway, this idea that we had gone from Trump as the given sort of expected next president to a completely different race, Anne-Marie.
Well, this is what Michael Shaoul was saying at the start of the show. He said this is on the margin, something that he did see, this unwinding in the Trump trade, just on the margins. It really was a perfect storm in terms of so many different issues hitting the market at once, probably the biggest for sure being also the growth scare and the data points, which is why this week is so interesting. So we're going to get that CPI report, and everyone is waiting for the Fed to lean in on some of this deterioration we're seeing in the labor market. And then what do we have over the weekend? Michelle Bowman coming out and saying actually inflation is still a top concern and we're not at the 2% target.
And Deborah Cunningham saying part of this is really just trying to push back on some of the expectations that got ahead of their skis. We also get Home Depot tomorrow. We get Walmart on Thursday at a time where people actually looking at the consumer, or Eric Resnick saying that actually people are still spending. They might be paring back on the margins, but this is sort of a normalization and not something that's more fundamentally weak. Why are people hooked into CPI as really actually even more important than some of the consumer data that we get?
I think it's so interesting because it is about how the Fed will react this week. If you get CPI even a tad hotter, expect more people to sound like Michelle Bowman, who we know is probably the most hawkish Fed member. So you can kind of brush that off, saying, of course, she's going to be talking about inflation. But if CPI does get in hotter, do you get maybe some of the more dovish side talking about this? Do you get their concentration swaying from the labor market, swaying from Home Depot, whatever they'd say, and say, sorry, folks, we don't have the luxury of cutting because inflation is still a problem.
Especially if people are trying to get ahead of the weakness that a lot of people are seeing more broadly in markets. We did see a pretty big, wild roller coaster last week that seems to have right-sized itself with some mild gains this morning, up about 0.25% on the S&P. A lot of this driven by what we saw in the currency markets, given the unwind of the Japanese carry trade. Dollar weakness, widely expected. We're going to be speaking coming up with Jane Foley of Rabobank about that and why that is likely to continue. 109.27 on the euro. 10-year yields. This is fascinating to me. How much is Deborah Cunningham kind of sounding the alarm and saying people still have not fully unwound some of their hopium about some Fed rate cuts and the ability of the Fed to keep cutting, and crude prices continuing higher after last week's rally, after a host of escalations in the Middle East, among others. Coming up this hour, Venu Krishna of Barclays, as traders brace for a big week of U.S. data. Lara, Rhame of FS Investments, and why she expects a slowdown, but not a recession, another person in that camp. And Jane Foley of Rabobank on her outlook for the dollar if Fed cuts next month. This is really what a lot of people are honing in on. We begin with the big issue. Stocks looking for direction after a volatile week, with traders pausing ahead of the data. The S&P 500 finishing the week roughly flat, rallying back after Monday's plunge. Wall Street now betting that Wednesday's CPI report will add fuel to the September rate cut fire. If the FOMC moves forward with a cut, Venu Krishna of Barclays sees a clear bias for defensive outperformance based on historical trends. Venu joins us now. Venu, thank you so much for being with us. Before we get into how you expect the market to respond, how do you understand what we just experienced in the market last week?
I think a huge element of it for the last few weeks, in fact, has been technical. And we feel that that probably has some more room to run. But in general, this velocity of the moves we are seeing, the magnitude of moves we are seeing, and the kind of underlying shock factor behind those moves all suggest that this is more technical in nature. But that said, I think on the fundamental side, there are a few data points which have changed. We had a weak claims number that reversed recently. And then you had a weak CPI number, but then you had a very weak PMI number. So I think there are some mixed signals which are coming out, which clearly has brought to the center the fact that perhaps the downside risk to U.S. economic growth is a little higher than what we thought. So in our own view, for example, we had assigned a risk for recession to 10 to 15%. Now it's probably 20, 25%, right? But still, our view at the end of the day is that the odds of a soft landing are much higher. And the risks have become a little bit more balanced versus accelerating versus a recession kind of environment.
You know, a lot of people are saying this is more technical than fundamental, and yet we've seen how technical can become fundamental.
Sure.
I'm curious what the vulnerability is currently baked in markets, especially if a lot of the leveraged trades haven't been fully unwound yet.
Yeah. No, I think that risk stays in the market because I think depending on which you're looking at, part of the unwinds are still probably left. But if we look at, for example, systematic strategies, things like vol control, like CTAs, our house view is that that's pretty much unwound quite sharply. For example, vol control was at 110% allocation. We believe they've cut to 50% quite sharply. But we are in an environment now where seasonally it's choppier. And typically in second halves, you see bigger drawdowns over history. And now the market is focusing to macro data back again. I know you were talking about CPI recently. And a week ago, if you looked at the S&P forward vol curve, then CPI was not important. In other words, you went away with the feeling that the market is telling you that the Fed is directing us that CPI is under control, what we care about the labor market. Come this week, it's changed quite sharply. Now the vol market is telling you we do care a lot about CPI, right? And so I think this back and forth is quite dramatic. So if I look at the forward 1 month, for example, where are the problems or what is the market really caring about? It's CPI, it's the ISM number, and the NFP number. So clearly it is more growth oriented and the market is really on the edge about whether US economic growth is sustainable and whether we end up with a soft landing or not.
I am really curious in this idea of this feedback loop, kind of to what Lisa was asking about. Does bad equity market performance feed into the economy? And I'm thinking of it specifically in, you hear Cisco over the weekend laying off thousands of people. We know Intel also laying off thousands of people. Is the very fact that investors are more willing to punish equities when they underperform directly feed into the economy, that you can have these companies who are looking for more levers to pull with margins and potentially laying people off? So again, you get a feedback loop of weak equity performance means weakness in the economy.
Well, I partly agree, but I think if you step back, the tech sector specifically, has been going easy on hiring for a while now, right? So after the 22 sell-off in big tech especially, they've been going very easy on hiring, and it's very targeted, mainly on machine learning and AI kind of areas. But I think the question is that the equity market has been posting excellent returns, right? And so you're at a point now where you need to take a breather. And for example, if you look at where the angst is in the market, you saw big tech in July and June rise almost 25%, driven by their valuation multiples going from 29 times to 34 times. That was a red flag, right? Because it's not as if their earnings are suddenly accelerating. If anything, big tech earnings are decelerating, even though they're still at a very, very healthy pace. So I think this is a market where the balance of fundamentals are quite decent, including big tech. But clearly, you want to be very careful about, for example, what multiples you pay for big tech, which has been dragging the market up on a consistent basis, right? So we would be comfortable in the 25 to 28 range. Anything more than that is risky, and correlations increase when big tech corrects. That's what you saw recently.
But when you see the correction like we saw last Monday, is that a time to get into big tech? Is that a time to really double down if you do think these are the growth prospects of the future?
The answer is yes. So our view is that it all depends on the entry point, right? So at 34 multiple, for example, we are uncomfortable. But once you come to the 20s, we are comfortable. The reason is big tech was growing at 60%, then 56%. And now this quarter, by the way, the expectation was 32%. They're delivering close to 40%. So the earnings, realized earnings growth are tremendous. At the same time, like I said, they are decelerating, right? The forward, if you look at 4 quarters, the expectation it settles in the 17 to 20% range. Now, that is a deceleration, but still extremely robust. So I think the question is, what happens in the future in terms of in the tech area, with the focus shifting to monetizing AI and things like that, and do these companies deliver these kind of earnings? If they miss on that 70 to 20% number, then I think we have a problem in hand. Because the rest of S&P is doing okay, but the creep is marginal, and the impetus and the ballast is coming from big tech. If there's a problem over there, that is going to spread.
This really raises this dichotomy right now in the markets. We were speaking with Tony DeSpirito of BlackRock, who thinks that we're seeing this broadening out and that actually you're going to see equal weight S&P catch up to the market cap weight S&P 500 that has been dominated by the big tech names. Yep. Sounds like you disagree.
No, we do agree with that, but I think it's going to be incremental. I think the hope for that trade has been there for 9 months now, and it hasn't happened, right? The same people telling you it's going to broaden, and we were on the other camp. We said, learn to live with narrowness, and that's what happened. Now, though, what's changed is big tech outlook is moderating somewhat because of the monetization angle, and rightfully so, and the huge amount of capex they're spending. Suddenly, people are waking up and saying, you're spending $200 billion. Like, what's the return? What I see today is hardly anything, right? That's important. But the broadening is the rest of S&P. For the last 2 quarters, we have seen a positive operating leverage in S&P, which means earnings growth accelerating faster than sales growth. And that has been partly aided by the rest of S&P as well, even though it's marginal. So I think incrementally, if you look at what numbers are telling you, you see big tech decelerating, but you have rest of the S&P accelerating. Where we are skeptical is the pace of accelerating, which the market consensus is telling you it's going to be 15-ish%, probably will be less than that, because half of S&P is still facing margin pressures as the extraordinary pricing power they exercised and they benefited with peak profitability is now rolling over as demand is moderating.
Venu, Krishna, thank you so much for being with us of Barclays. I love all the sanitized way of saying that consumers just won't take it anymore and are saying, absolutely not. If you're going to hike prices by 10%, we're not going to buy. I mean, that's basically what we've been seeing now.
Unless you're going to a luxury resort somewhere.
The bifurcation depends who you are.
Depends if you're with Bleacher or what was the other one? Leisure or Lizness?
Lizness?
Yeah.
Lizness.
Well, let's get you an advanced stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Hackes. Yahira.
Hi, Lisa. Israel is strengthening its infrastructure defense as it faces heightened risk of attacks from Iran or its proxies in the Middle East. It comes as Iran reiterates its pledge to seek revenge for the killing of a top Hamas official in Tehran. Meanwhile, Hamas called on mediators to come up with an implementation plan for a ceasefire based on earlier talks rather than begin a new round of negotiations with Israel. The U.S., Egypt, and Qatar have scheduled new talks this week, which Israel has said it will send a delegation to. Germany's economic outlook is facing the bleak prospect of hardly any growth this year. GDP is expected to rise 0.1% in 2024, down from a prior prediction, according to the medium forecast in a monthly Bloomberg survey. Data has shown the country's industrial woes are continuing to hold back growth, causing Europe's biggest economy to unexpectedly shrink in the 3 months through June. And former President Donald Trump plans to sit for an interview tonight on X with its owner, Elon Musk. The billionaire is promising an unscripted discussion with no limits on subject matter. Musk often butted heads with Trump when he was in the White House, but he endorsed the former president after the attempt on his life last month. Elon Musk's interview with the former president is set for 8 p.m. tonight. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Danny, evidently the House of Lords messaged in to weigh in on leisure versus Lizness.
Correct. A Lord has messaged me saying that it is leisure, not leisure, so it needs to be leisure.
This is why we don't have lords in the United States.
Well, there we go.
The very reason.
Anyway, let's move on. Up next, the morning calls, plus Daniela Bretthauer of HSBC ahead of a big week for retail results. That's coming up next. This is Bloomberg Surveillance. Is it over yet? That is the key question this week after last week's tumult. We had a roller coaster of volatility, of a spike up in yields with respect to credit, a spike down in yields with respect to treasuries. And what you're seeing today in markets is calm. Evidently, for now, it might be subsiding. Right now, we're seeing S&P futures up about 0.25% at 53.83. Euro really gaining pretty much across the board last week. Right now, 109.23. A real question here, and I want to sit on this for a second. Danny, how much currency volatility really was underpinning all of the drama last week?
And maybe that's why today is calm, because Japan's on a holiday today, so we don't have that trade. The thing that I think is interesting to contemplate, even if currency volatility was the thing that started it, are we in a position now where big cap tech and the Japanese yen are just linked, even if they shouldn't be? I mean, a lot of people said that people are funding their tech trade with the currency, but doesn't mean we'll get in a position where come NVIDIA earnings, if they're volatile, that you also see a reaction in the yen? Is there some sort of interlink between the two now, just because we did have Monday's event and it showed some sort of strange relationship between the two?
There's also a question about other crowded trades that are getting some fundamental rethinking, and I'm thinking of crude. And Anne-Marie, I know this is your bailiwick in a lot of ways. We're not just seeing increased tensions in the Middle East, which seems like an ever-present kind of drum be in the background, but also a lot of oil producers are actually cutting back their production and saying they're worried about a glut of oil. How much have we seen a really changed landscape in crude?
Yeah, Javier Blas recently wrote about this, trying to maintain that floor for OPEC Plus at $75. This is something that actually they probably would like to see a lot higher, but even $75 is hard to maintain. Most notably, the U.S., even more of a record producer now, 13.4 million barrels a day. At the same time, what did we discuss this morning? Record amount of outflows coming out of China. You see a growth weakness in China, which notably that would be the place that you'd see a driver for more consumption.
Well, time now for the morning calls, looking beyond macro to micro. First up, Piper Sandler upgrading Robinhood to overweight with a price target of $23. The analyst citing the stock's recent pullback as an attractive entry point into a, quote, innovative, fast-growing brokerage platform. Next up, Wolfe Research downgraded Qualcomm to peer perform, seeing headwinds as Apple swaps supply chains for its iPhone 18 AI processing modems, expecting Qualcomm to lose market share on all but U.S. phones. And finally, Evercore initiating a tactical outperform trading call on Walmart ahead of Thursday's earnings report. The analyst praising the big box retailer as a, quote, steady ship providing a port in the storm of consumer volatility. Sticking with retail, Daniela Bretthauer of HSBC maintaining her reducing rating on Home Depot, but lowering her price target to $318, citing the pressure of higher interest rates and lingering pandemic effects with do-it-yourself customers stuck on the sidelines. Daniela joins us now. Daniela, thank you so much for being with us. Just at an overview level, where are we in terms of the normalization post-pandemic where everyone went to sort of shore up their homes because they were going to be stuck there for the foreseeable future?
Hi, good morning, everyone. Thanks for having me on the show. Let me begin by sharing you our base case scenario for the U.S. economy, which stands the Fed should start easing in September and the U.S. economy avoids a recession. So that's HSBC base case scenario for the economy. And according to our regression models, currently, the market is pricing a 30% chance of a recession, up from 10% of a risk of a recession last week. So with this easing, the U.S. economy would avoid a recession. And we recently increased the number of rate cuts this year to 25 basis points, to a cumulative cut of 75 bips. And with regards to Home Depot, the current price is broadly in line with the stock's value in the last 6 months. It has been a favorite name for income investors that look for dividend yield. We have a 2.5% dividend yield for Home Depot. But, Home Depot has missed Wall Street's revenue estimates 3 times over the last 2 years, and weak consumer spending, higher interest rates, and the economic downturn recently could hinder sales recovery for the home improvement projects and negatively impact Home Depot's growth.
Daniela, we've been talking a lot about the bifurcated consumer, that you're seeing weakness on the low end. Is there any sign in any of these earnings that it is starting to migrate upwards?
So, yeah, thanks. Great question, because over the past few months, we saw more evidence of a tired consumer. Large cap names such as Walmart that operate in a more defensive sector of consumer staples tend to outperform under a risk-off scenario. And Walmart, which reports on Thursday, it's usually perceived as a good proxy to the state of the U.S. consumer.
Daniela, though, it's not just a good proxy for the U.S. consumer. According to on the lower end, according to Walmart's last earnings report, they talked about wealthier consumers trading in, trading down. So is this just says something about the consumer as a whole, or is it about Walmart taking market share from other players?
So the takeaways from the Walmart quarterly results are: 1, consumer wallets remain stretched, but they responded well to Walmart's strong value proposition. 2nd, food inflation continues to moderate. It's down from where it was at the end of last quarter, and it should stay at low single-digit rates for the rest of 2024. And 3rd, the U.S. consumer, even the wealthiest one, is now shopping at Walmart. So they do have reported market share gains among higher income consumers.
Just quickly, Daniela, is there anything in the earnings or some of the commentary that you've been really focused on that suggests that we're headed into a bout of real consumer spending weakness beyond what people are expecting?
No, I think that it has, as you put it, it has been bifurcated since the beginning of this year. So consumers are spending more on travel and, other discretionary purchases rather than complex housing projects or remodelings of their homes. So I think this scenario, until we get, again, a clear picture from the Fed, but even if we do get the cuts this year, it's something that only in 2025, given the new government and the results of the election, then I think that's where we'll get a more defined scenario for the U.S. consumer.
Daniela Bretthauer of HSBC, thank you so much for being with us. Appreciate your insights. Really interesting to see sort of the push-pull right now and the dichotomy between the Home Depots of the world still struggling under some of the changes in that industry versus Walmart, which is cashing in on pretty much every trend, Anne-Marie.
Absolutely. And with Home Depot, it's really these big ticket items that you just don't see consumers coming back like they did during the depths of the pandemic when they had flush with cash and really nowhere to go or spend it. And then Walmart, I still can't get over what the CEO said last earnings call. We are starting to see more wealthy consumers come to Walmart and trading in. They're looking for deals as well.
See, this is interesting. An idea that you can have this almost investment play where you say, what actually benefits from higher end consumers coming down? Is it Walmart? Is it a Disney park? Because people aren't going abroad. They're just going to parks instead. It depends whether they want, Mickey Mouse or Donald Duck or whether they want, food.
Coming up next, Lara Rhame of FS Investments, as well as Jane Foley of Rabobank, as we parse through the debris of last week's volatility and take a look about whether it will continue. This is Bloomberg. Welcome back to a week where we gut check the volatility of last week. Markets seem to be calm for now with about 0.25% gain for the S&P 500. Let's whip through the markets and really understand where they are after a week of up and down and then leaving pretty much in the same place that it began. So basically it was okay to take the week off. That is what I am told by everyone. Right now, the S&P futures up 0.3%. NASDAQ futures up 0.4%. The Russell 2000, Danny, lagging behind even after all of the hopes and dreams of this broadening out. Russell 2000 still not really seeing those kinds of outsized gains.
And it's such an unfortunate time because how many people did we hear the rotation is finally come? It is finally time to buy Russell 2000, even if it's not about the politics. I mean, you heard that too. Sure, the Trump trade catalyzed it, but if the Fed's going to cut, then it means you can buy Russell 2000. The fear is that the Fed is cutting because the data is starting to deteriorate. And if that's the case, can you really be buying small caps?
What does widening out mean? Does it mean small caps that are more susceptible to rate cuts actually helping them, but also more vulnerable to weakness versus just the rest of the S&P 493 catching up? If you take a look at what's going on in bonds, that really is the underpinning of a lot of what we've seen. A huge expectation for Fed rate cuts after the weaker than expected jobs report and a host of trades being unwound, frankly. Two-year yields have retraced a lot of that, now about 4.04%, although actually down on the day after earlier having been up, still basically range bound. This isn't pretty dramatic. 10-year yields 3.93 and 30-year yields 4.22. I hear that last week auctions were interesting. Make auctions interesting again. Danny, was this something that really triggered some of the gut check about how far some of the rally could go?
Well, it was a feeling of if yields are below 4%, are we really going to add more duration? And if yields are below 4%, do we start caring about the deficit? Because if this is the trajectory, does it mean auctions are going to start looking like 2023? In other words, Lisa, the market saw you were off and said, maybe now is the time to freak out.
Yeah, well, I was looking at it on my phone to try to have bleisure. Meanwhile, in the currency markets, you are experiencing that dollar weakness pretty broadly. That really is one of the key questions here. Euro gaining 109.23, and coming up, we're going to be speaking with Lara Rhame, who has changed her call somewhat as a result not of euro strength, but of dollar weakness, given the expected Fed rate cuts and the Fed reaction function to a lot of the economic data that we have coming down the pike. Under surveillance this morning, Kamala Harris raising more than $12 million in an event attended by top Democratic donors and politicians. This, as the latest New York Times Siena College poll shows Harris with 50% support compared to Donald Trump's 46% in key swing states, Wisconsin, Pennsylvania, and Michigan. Anne-Marie, over the weekend, a lot of data, both on the funding point as well as on just voter appetites, giving them a real boost.
Yeah, and I would go back to what Libby Cantrell told us, which is don't really look into the polls until after Labor Day. But if we're going to play this game and look into the polls, I love what the Financial Times put out. Because on the top, it looked like Harris has finally caught up to Trump, especially on the issue of the economy. That actually more voters say they trust her in the economy than Trump. Trump has always been the standout. But then if you look under the hood, really interesting numbers. 42% said they'd be much or somewhat better if Trump won another 4 years in the White House, and just 33% said they'd be better under a Harris presidency. And actually what you saw is that most respondents said Harris needs to distance herself from Joe Biden. This idea of Bidenomics, they're going to be on the trail together this week. I want to know if that actually helps or hurts her.
I think that distinction you draw is so important, of more people saying that Trump will help them personally, better off financially, because people vote in their own self-interest. So the idea that a Harris campaign can take a victory lap after this isn't quite so. It goes back to what Terry Haines said. She has momentum now, but there are lots of stumbling blocks ahead. And perhaps they need to position themselves and get a coherent message around the economy, be it distancing themselves from Biden, in order to kind of keep that momentum going.
Next week, the DNC, you will be there, and we'll be covering that in terms of how much of a boost that gives and how the messages change tonight at 8 p.m. Eastern. You do also have Elon Musk interviewing Donald Trump, the former president, on X, formerly known as Twitter. We'll start to get a better idea of how the U.S. consumer is faring as Home Depot and Walmart report this week. Home Depot's same-store sales expected to slump for a seventh straight quarter, while Walmart's ability to appeal to all income levels could protect it from consumer weakness. This is the interesting aspect of these two companies, Danny, that on one hand, you have Home Depot struggling with a lot of secular kind of housing-related issues overlaid with the consumer appetite, and Walmart is just basically cashing in on all sides.
It's this thing that every time we look at earnings, we say, is this idiosyncratic? Is it just a Delta problem that their earnings weren't great? Is it just a CVS problem? But maybe that's the point. When you have these individual companies make missteps, the market is less willing to forgive it, because if you don't have that economic growth, you can't kind of paper over some of the issues. So with Walmart, is it the opposite? Are they just doing better because they position themselves well for this moment? Or is this moment, should we have a bigger read of it, that it does suggest that it's not just a lower end consumer struggling, that maybe it's moving upwards?
Well, yeah, and is Walmart an actual consumer staples company, or is it, an advertising company, or is it a media company, or what else is it doing, given the fact that it's really cashed in on some of its platform and technological edge? Meanwhile, traders are bracing for a big week of data, U.S. PPI and CPI coming on Tuesday and Wednesday, respectively, followed by retail sales and another round of jobless claims on Thursday. This week's inflation data is the next crucial print ahead of a widely anticipated September rate cut. Joining us now ahead of all of that is Lara Rhame of FS Investments. Lara, great to see you. Thank you for being with us. I want to start there in terms of what you're expecting to see with respect to economic deterioration to either confirm or really kind of question what we saw in the non-farm payrolls report for July.
I think the way that I'm describing the evolution of the economy right now is an incremental slowdown. And it's hard to remember. The beginning of July feels like a lifetime ago, but everything was maximum optimism, volume 11, like no slowdown from a very strong pace of growth for as far as the eye could see. And I think what we're facing now is a deterioration to something that's more sustainable. I want to be clear, I don't see this as actual weakness. But for markets who've been only given upside surprises for 6 quarters now, it's an uncomfortable surprise. And we're seeing the downside of that hyper concentration that you spoke of off the top.
I like your reference to Spinal Tap and the everything to 11 comment earlier. There's this issue also, though, of just how much room the Fed does have to respond. You believe that they do have the luxury of being able to cut rates because inflation has been coming down. And yet you have been among the people for the past couple of months who've been saying that the upside surprises to inflation might be much more considerable than people expect. How do you pair those two ideas?
This is a tough needle to thread. And to me, the Fed now is very, they're going to cut rates. I think the biggest question is, are they very badly behind the curve? And that's where I would say no, for 3 reasons. One, our economy is just less interest rate sensitive than it has been in the past. So we're going to get a Fed rate cut The question is, how much juice is that actually going to give us in the near term? I think the second reason for me is that while clearly we're facing a really nice soft patch of inflation today, I think when you look just a little further, several quarters ahead, some of the problems of rent, of services are probably not going to go away. I don't think the Fed has the latitude to just slash rates down 200 basis points over the next 4 quarters like markets want. Again, unless the economy really changes trajectory. And I think the third thing is that they know they have a little bit of time. You know, we've seen real rates correct down. I think that if they really feel like they're seriously behind the curve, they are going to take that chance to cut. But one payroll report, it's just too volatile. I don't think that's enough to really move the needle significantly.
I was going to say, because when they talk about having more time, they often talk about it in the context of this labor market, that yes, hirings have slowed down, but layoffs haven't started. To that, Neil Dutta of Renmax says that they're playing with fire, that hires slow before layoffs, and using layoffs as a crutch is unwise. What do you make of that, Laura?
I think he's really, and this is an important point, because the unemployment rate moves asymmetrically. By that, I mean, it goes down really slowly and it shoots up. And we do have a really, I think, scary history of this asymmetric response in the unemployment rate. But if we're going to be all in on the soft landing, and we don't have to be, I think landings are bumpy, and that's one thing that we're experiencing in markets. We need to watch the unemployment rate like a hawk. And we need to really be, you know, if it gets to 4.5, if it starts to move in 0.2% increments every month, I think that's a situation where the Fed does cut significantly. But this is an important tipping point. And I think you look back to the one case where we didn't have a recession when the Fed cut rates, the mid-1990s, you did see the unemployment rate kind of move up a little bit and then stop. But it's a tricky time. I would agree with that.
Well, where we are right now in the unemployment rate at 4.3% is roughly where the Fed wants to see us at the end of the year. So where do you think the unemployment rate will be at the end of 2024?
I think we're going to be about here, around 4.25. And again, this is the dance of, you know, a lot of companies actually announcing capital expenditures in their earnings calls. You know, we're going to need a lot of investment to put things like AI into practice. This is, I think, where markets got ahead of themselves. It's not just a profit story. It's also a spending story. That's great for the economy. It's great for growth. It's not so great for free cash flow yield. And that's, I think, why we've gotten this real snap back, because you have the problem of concentration. And when we talk about the need for investors to widen, I would absolutely agree with that. It's even beyond traditional markets, because what we're seeing today is, I think, good for the economy and good for productivity growth. But for publicly traded markets, it's a challenge.
Just to sort of finish up, looking ahead to this week, what do you think is going to be the most compelling data point or earnings release that could shape your view going forward?
I think CPI is going to be important. I think retail sales are going to be important. You know, the CPI numbers, markets are really just looking to check the box on the Fed, you know, putting that rate cut into place. I expect it to be another friendly report. We're going to see a lot of volatility. That just the next quarter, brace for that, because Fed policy expectations are going to swing around. I'm still only looking for a 1/4 point cut, but you roll right from that into the elections, where we know the volatility picks up in the 2 months before an election hits.
Lara Rhame of FS Investments, thank you so much for being with us. Joining us now, someone with a call on what's going to happen with the euro, Jane Foley of Rabobank. Jane, you actually recently changed your view on the euro to actually increase it, seeing a likelihood of 110 rather than 105 previously versus the dollar, because not euro strength, but dollar weakness. Just pairing this with what we were hearing from Lara, Jane, how much do you see this hinged from U.S. weakness versus just simply rate cuts that might be beyond what people expected?
Well, There's obviously a lot of different stories interlapping into the euro-dollar story. But I think, if we go back to the start of the year, we'd always had the view that the dollar would weaken towards the end of the year because that's when we were anticipating that the Fed would start cutting interest rates. And so we're coming up towards the end of the year right now. And, it is our view that we are likely to see a Fed interest rate cut in September. But, I really must caveat that, because if we go back a week when we had the market anticipating really aggressive Fed interest rate cuts, we were never of the view that that was going to happen. I think what we saw a week ago was a combination of a lot of different factors all coming together, and one part of that was positioning. The market was too positioned in the carry trade, too positioned short the yen, too positioned perhaps long in tech stocks, too positioned perhaps in US equities, and I think a retracement happened all at once, which created the chaos that we saw. But our view all along is that, we'll have some moderate Fed interest rate cuts towards the end of the year. We're still of that view.
How much do you think that some of those carry trades have been fully unwound? How much are left?
Well, that question again needs to be put in some sort of perspective. How much should be unwound? I mean, certainly if you were in the carry trade, maybe at the start of last year, you'll probably still be in the money. I mean, certainly if you look at some currencies, maybe MEX against the yen, currency trades like that. I think we have unwound more or less everything that we are going to unwind right now. And the reason for that, particularly when we talk about dollar yen, is because I think the market has to still settle down in terms of the views on the Fed. I think the market was far too excited a week ago in pricing in too many Fed interest rate cuts. The data this week clearly in terms of the US economy is going to be really imperative of giving the market a lot more balance in terms of what is really realistic from the Fed. And at the same time, well, yes, maybe the Bank of Japan can hike interest rates again, but maybe that won't be till the start of next year. So from that point of view, I think a lot of the really extreme positions, and there was a lot of them, have been washed out right now. And I think maybe dollar yen can settle at maybe still relatively volatile, but nothing like what we've seen. So maybe 145, 147, that sort of trading band until we get more data to really clarify what the fundamentals are suggesting for that currency pair.
Jane, is there some degree where just the carry trade isn't attractive now, that it's linked to low volatility? And if we're entering a summer that's already been volatile, if we're entering a period of politics, and as you mentioned, the uncertainty over the Fed, that even when trades do unwind, they won't be put back on?
Yeah, I mean, you are right there, because one of the reasons that the carry trade has been so popular in FX this year has been because volatility has been, really very low. So if you enter into an environment with higher volatility, high news events, and certainly, the Fed and the US election are really big news events for foreign exchange. Yeah, there is the likelihood that those sorts of trades will become certainly, less fashionable. And we're not, I would expect, going to go back to the situation that we were in, maybe about a month ago with everybody and their dog, short of the yen. I don't think anyone's really anticipating that's going to happen. But, at the same time, it is the nature of foreign exchange that there is going to be some degree of carry trade in there, but just not as popular as we were just a few months ago.
Jane, last time you were on, we talked about the dollar and what it means for this Trump trade and how sometimes the policies Trump talks about means a stronger dollar, but he's been on the record talking about how he actually wants a weaker dollar. Do you have any idea on how the dollar would trade with a Harris administration?
Well, I think we've already seen some of this coming through. The Trump trade, we all started talking about it hugely, of course, after that debate between Biden and Trump. But now that Biden has stepped back and Harris is there, and Harris is doing better in the polls than Biden was doing, then the market's obviously scratching its head and thinking, well, maybe we were too hasty in pricing in this Trump trade. So, if we assume that Trump would bring in more aggressive tariffs, if we assume that there was more chance of tax cuts under Trump, well, they're inflationary, therefore it's suggestive of less Fed cuts, and therefore it's more dollar
dollar positive. We can assume perhaps that Harris would be more friendly in terms of her allies when it came to tariffs, because I think the direction for protectionism is still going to be there, but perhaps less so under Harris than under Trump. But if we assume that there is less reason to panic so much about tariffs, then we've got to assume that maybe the Fed is going to be able to cut interest rates a little bit more, and that's dollar negative. But of course, putting a spanner in the works is the Trump and the Vance dialogue about the president should be able to control interest rate policy. Now, I don't believe that would happen, but if it were, then we're looking at a completely different outlook for the US dollar.
Jane Foley of Rabobank, it has not been a boring August for you. Thank you so much for all of your insights, and talk with you again soon. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hakis. Yahaira.
Hi, Lisa. Scotiabank has agreed to buy a minority stake in KeyCorp for about $2.8 billion as part of a focus on increasing the bank's footprint across North America. Scotiabank will acquire just under 15% of the Cleveland-based bank, with shares purchased at an 11% premium to their volume-weighted average price. KeyCorp has about 1,000 U.S. branches and oversees about $187 billion in assets. KeyCorp was among the hardest hit regional banks in last year's crisis after the Fed hiked interest rates. Meanwhile, OPEC trimmed its forecast for global oil demand this year and next as the cartel prepares to decide on planned supply increases next quarter. In its monthly report, OPEC said it could pause or reverse the increase depending on prevailing market conditions. Oil prices have fluctuated in recent weeks as concerns over escalating tensions in the Middle East were offset by signs of weakening economic growth in China and the U.S. And Paris handed over the Olympic baton to Los Angeles in true Hollywood style, having actor Tom Cruise rappel from the roof of the Stade de France into the closing ceremony. LA will host the next edition of the Summer Games in 2028, and already planning is underway, with the city's mayor addressing the big issue, saying they'll encourage remote work and non-standard working hours to prevent traffic chaos during what she's calling a no-car Olympics. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. That was actually really exciting to see Tom Cruise kind of go in and sweep down. And
unbelievable. He's in his 60s. Can you imagine? He does his own stunts still.
Yeah,
so cool.
I'd say it was cooler when the Queen of England did it in London.
When she swooped out on the
yeah. I mean, it was fake, but it was, still cooler.
Then it was called.
You're just playing into the lords that are watching.
Up next, setting you up for the week ahead, you're watching Bloomberg Surveillance. Less than 40 minutes until the opening bell here in the New York. Here is your trading diary for the day as well as the week ahead. Today at 8 p.m. Eastern, Donald Trump sits down with Elon Musk for a live interview on X, formerly known as Twitter. Tuesday, we'll get U.S. PPI followed by Fed speak from Bostic plus Home Depot earnings. Wednesday, CPI, don't miss that. Thursday, retail sales plus another round of jobless claims that are taking on increasing importance, and more Fed speak from Musalem and Harker. We'll also get earnings from Walmart. Rounding out the week on Friday with a UMich sentiment survey plus more Fed speak from Goolsbee. Joining us now is Bloomberg's Michael McKee. Mike, it seems like Fed speak actually matters a whole lot more this week than it has in previous months.
Except.
Oh, come on.
We've already heard a lot from Austin Goolsbee and a little bit from Raphael Bostic, so I don't think we're going to get a whole lot more there. Alberto Musalem from St. Louis hasn't spoken very much at all since he took office at the beginning of the summer, but it may be interesting to hear what he has to say about it. Probably the most interesting aspect of Fed speak recently was actually over the weekend with Mickey Bowman, the Fed governor, saying even if we get the numbers we're expecting this week, we might not need to cut rates yet. As one analyst this morning put it, there's two things here. There's one is what the numbers say, and two, what the Fed's reaction to those numbers are. And we're going to get the market's reaction to the numbers, but we really need to hear from someone like Jay Powell or John Williams before people have a pretty good idea of what we're going to be seeing in September.
Given what Bowman said, when we look at this week's calendar, Do we need to be coalescing around CPI? Is this the data point if they're still worried about inflation?
Actually, unless there's a big surprise with CPI, I would point to retail sales. And the reason being, we all know that we're making progress on inflation and it's incremental and it's really slow. And we are expecting PPI and CPI to show very slight declines. But retail sales feeds into the narrative of whether or not the economy is really slowing, follows on the jobs report. And so we'll want to see if there's an additional warning sign, an initial flashing red light about the economy. For that reason, also the University of Michigan survey, while it's not directly related to spending, will also tell us something about how people are feeling.
Mike, 85 days to the U.S. election. We hear now the candidates starting to talk about the Fed almost on a weekly basis. J.D. Vance yesterday doubling down what Trump said in terms of, fundamentally this should be a political decision when it comes about interest rates. Are Fed members going to have to respond to this?
Well, they probably would once somebody is elected. They're not going to say anything beforehand. You may hear in speeches, as you have heard for the last number of years, that Fed officials think Fed independence is important, but they won't tie it to the political campaign itself. Now, if Trump were elected, and especially if both houses went Republican, then the Fed would have a problem and they would start marshaling their lobbying efforts as they did when Dodd-Frank was written. But if you even get one house that's Democratic, it's probably not going to be enough for rewrite of the Federal Reserve Act.
Michael McKee, don't be a stranger. You're not. Thank you for being with us.
I'm not.
This week, you'll be joining us pretty much on a daily basis, and that is a good and beautiful thing. Coming up tomorrow, Mark McCormick of TD Bank, Matt Brill of Invesco, Keith Lerner of Truist, and Matt Lazzetti of Deutsche Bank. What do you think the conversations are like in the Fed committee when they get some of the criticism from politicians?
Well, Austin Goolsbee was asked about this last week on Fox Business, and he said cutting before all the politics surrounding it makes him a little uncomfortable. I imagine this is very uncomfortable. And they have to go out of their way to not look political, which in essence almost feels a little political.
Which is kind of the discussion that some people are having. We'll continue to have that conversation. I'm sure tonight there will be some commentary about the Fed as well in the conversation on X, also known as Twitter. This was Bloomberg Surveillance.